Okay, now see here, our next topic is double taxation. Even this topic is most important. Practically, almost every exam they put one question on double taxation. Okay, first I will explain when does double taxation arise, and then I will explain what is the solution for that. See, everyone will agree that no one can tolerate double taxation. See, income is only single, but on that one income, if you have to pay the tax twice, no one can tolerate. So there is a solution for that. But first tell me, when double taxation arise? So see, whenever you reside in one country and if you earn from some other country, then only double taxation will arise. Because see, if you reside in India and if you earn the income from India only, then only India is involved, no? Then there is always single taxation. Like see me, I am residing in India and my source of income is in India only. My classes, my students are in India only. So I reside in India, my source is also in India, then I will never face double taxation. But if I reside in India and my income comes from Singapore, look at the drawing now, look. This is me, look at this is Shirish Vyas. He resides in India. Can you see resident? You reside in India, but your income is coming from Singapore. Then there will be double tax. Why? Because when this income you earn, what will government of India say? Dear Shirish, your income might be coming from Singapore. Let it come from London. Let it come from Australia. You are residing in India, and being a resident of India, it is your duty to pay tax to India. Because government of India will say, Shirish, you cannot reside for free in India. You want to reside, pay taxes. Then if I say, but no, but my income is coming from Singapore, let it come from Singapore. Let it come from any corner of the world. If you want to reside, you will have to pay tax in India. So see, India will tax me. Can you see tax in the cloud? Now, what will Singapore government say? Shirish, you might be staying in India, but your income is generating from Singapore. From our country, if you are earning the income, we will tax you. Then if I say, but I stay in India, you stay wherever you stay in hell. Your source of income is Singapore. So when Singapore is generating income for you, we will also tax you. So see, assume this foreign country is Singapore. Huh? So actually speaking, both the countries are right in taxing me at their place. Okay, India is right. They have got the right to tax me based on me residing in India. And Singapore has got the right because the source of income is Singapore. So they will tax me. So only in such situation double taxation will happen. Okay, see this. India is also taxing, Singapore also taxing, and income is single or double? Income is single, but tax is double. In short, you can make a thumb rule. Whenever we reside in one country and your income comes from some other country, you will have to suffer double tax. But tell me, will law let us suffer double? No. They have to give us relief. See, he is crying. Can you see? He is sad. He wants relief. Now, how to give him relief? That depends upon whether India and that foreign country has datta or not. What do you mean by datta? Double taxation avoidance agreement. Like assume in my example this foreign country is Singapore. Assume this is Singapore. Now if between India and Singapore, if there is a double taxation avoidance agreement, then relief will be given in a different style. But if there is no agreement, then also relief will be given, but in a different style. See, whether our country has got datta with that foreign country or not, that doesn't matter. Ultimately, relief will be given. Because no one can let you suffer the double tax. Because you being doubly taxed is a torture. Income is only one. But why to pay double tax? Double tax torture you will never suffer. You will get the relief. But depending upon whether our country has got agreement with that foreign country or not, the type of relief will change. See, precisely I want to say this. Look, if Read this. If India and Singapore, assume Singapore has got double taxation avoidance agreement, then relief will be called as bilateral relief. You know why it is called bilateral? Bi means both the countries are ready to help you. Like imagine this is Shirish Vyas. Shirish Vyas is resident of India. So if I suffer double tax, India and Singapore both will support me. And when both the countries are helping me, it is one-sided help or help from both the sides. Help from both the sides. Both means bilateral. Feel the word bilateral. But see, that bilateral support you can expect when our country has got agreement with foreign country. But look here now. If India has no datta, what is datta? Double taxation avoidance agreement. Like imagine this is Pakistan. And as everyone knows, India does not have good relation with Pakistan. And imagine India and Pakistan do not have any double taxation avoidance agreement. They have not made any agreement of how to avoid the double tax. Then what will happen? Then also, I being resident of India, government of India will help me. What government of India will say? Don't worry, Shirish. We are there for you. See, we cannot expect much from Pakistan because we don't have any agreement or any relation with Pakistan. But you are resident of India, we will take care of you. We will take care of you one-sided. One-sided means unilateral. See, why it is unilateral? Because it is only India who is ready to support me. And Pakistan is not giving me any support. See, support in what terms? Slowly you will understand. But when India and Pakistan do not have any double taxation avoidance agreement, then I cannot expect any support from Pakistan. But I being resident of India, I can expect support from India. Na? But when India alone supports me, India alone, it becomes unilateral relief. Okay. Now, see, basically the objective of this topic is what how to calculate the relief. See, relief means what you have got the pain of double tax. Do two taxes. But at the end, you will get some relaxation. Means your tax liability will be reduced. But how to calculate the relief, that is the main headache in the chapter. But that I will take later on. First understand what are the different types of relief. So first relief is called bilateral, other is called unilateral. Now, in bilateral relief also there are two methods. Exemption method and tax credit method. Tell me, when do we say it is a bilateral relief? When there is datta between the two countries. So imagine this is India and this is Singapore. And India and Singapore has made an agreement, and sometimes in the agreement what they write, whenever some income is earned by Indians from Singapore, Singapore will tax, India will not tax. Means in the agreement only they have decided, okay, for interest income, Singapore you tax, India we will not tax. Automatically double taxation eliminated. See, in agreement we make terms and conditions. So when Indian government, Singapore government, they sit face to face, they discuss that for interest income you tax, and for PGBB income we will tax, for royalty income you tax, for capital gain we will tax. Means one will tax, other will exempt. This is called exemption method. See, in exemption method there is no double tax only, because in the agreement only we have entered into the terms that on so and so income who will tax. See, exactly which country will tax, which will exempt, there is no rule for that. It is depending upon the provisions of the agreement, and agreement is different for different countries. Like see, for example, if India, Singapore has agreed that whenever Indians get interest income, Singapore is going to tax. So that means India will exempt. So tell me, here is there a double taxation? No. We avoided it. We avoided it. That's why it's called double tax avoid agreement. But for that we had agreed, na? Otherwise, see, if there was no agreement, India will say what? Interest income Shirish is earning, we will tax him. But if we have agreed, then we will not tax him. So this is called exemption method. But you know, in tax credit method, what happens? Both the countries will tax you. Like, see, if some income comes from Singapore, India will say, we will tax Shirish because he resides in India. And Singapore will say, we will also tax Shirish because he is earning from Singapore. Both the country will tax. Now Shirish will cry, both are taxing me. Don't worry. For the time being, both will tax you. But later on, you will get the credit. This is working in the form of TDS. Like, you know, in TDS also what happens? Sometimes on your income, TDS has been cut. But still, you take that income in the computation. Na? But eventually what we do? After you add surcharge, health and education says, at the end, whatever TDS is deducted, that much credit you get. So that way, this method operates. Means in tax credit method, what will happen? Both the countries are going to tax me. Means while doing the computation, while filing return in India, it will pain that Singapore also tax. Once again, I have to show in my filing of return. But don't worry, after 5 heads are computed, after you do that Satak, Latak, winnings, balance, at the end you will get some relief. Okay. So that is called tax credit method. See, still I have not explained the calculation part. How to exactly do the calculation, that I will come. But first understand what are the different types of relief and the methods. See, in unilateral relief, there are no two methods. Now, how unilateral relief operates, that I will explain afterwards. But I'll just give you one hint. Even this operates like tax credit method. Even unilateral relief operates like tax credit method. Means like this is India and this is say Pakistan. Or someone has got income from Pakistan. So Pakistan will tax you. India will also tax you. But India will have soft corner with SHIRISH VYAS because after all SHIRISH is of India and SHIRISH will get some relief from India. And even that will work in the form of TDS only. Means first in my filing of return I will show Pakistani incomes. I have got income from Pakistan. Huh? So in my 5 heads of income I will include Pakistani income. And whatever tax I had to suffer in Pakistan, I will get relief in the form of TDS. In short, even unilateral relief operates like TDS. See, both this relief operate in the same manner, but calculation is different. Okay. See, I am not going into the exact calculation. See, here there is actually no calculation required. Where exemption method, because exemption method is straightforward. That in the agreement only it's written that Singapore will exempt, India will tax. So there is no double tax only. But calculation arises when both the countries are taxing and at the end you want a relief in the form of TDS. Their calculation is required. So see, I have given you the broad idea of how double taxation relief operates. Now see, my next plan is what you know. First I will explain how this tax credit method operates and then I will explain how this unilateral relief actually operates. See here. Can you see? I will show you 2 slides. This is slide 1 and then I am changing the page. See. In this 2 page only theory will get over. Page 1, page 2. But in this theory you will not understand the concept. Concept you will understand only when I actually solve one question in front of you. Right now you just see the theory. See, first let us assume there is data. Please imagine this is SHIRISH VYAS having income in India from Singapore. And between India and Singapore there is a data. Actually India has got data with most of the countries in the world. Most of the countries. Round about 100 datas India has made. With each country different agreements are made. And how datas are actually made, that is also there in a separate topic in your syllabus. There is one topic called Model Tax Convention. There you will study how datas are actually made. Here you will not study that. Here you have to understand, yes, there is some data. How it is made, forget it. If there is data, how do we get the relief? That's what we are studying in this topic, okay? So now, let's assume that we have data with foreign country. So, how your computation will be shown. See, first, assume in my example, I am getting income from Singapore, Shirish Vyas. So first, Shirish sir will write his Indian income from coaching class. This is my example. Take me in the example. So for me, Indian income is my coaching class in India. Plus, I am getting income from Singapore. That is my foreign income. Even that I will include in my computation. But including this hurts me. Why it hurts? Because on this income, Singaporean government has already taxed me. And I have to include again in my India return filing. It hurts, but it's okay. At the end, I will get the relief. So first you have to include that Singaporean income in my computation. And then see, this is my GTI. All this is normal, right? And at the end, after health and education says, I will get relief under section 90. Please note the section. Whenever two countries have made agreement, the relief is called 90. But if there is no agreement, relief is under section 91. I had the section. Section 90 you have to quote when India has got agreement with foreign country. 91 if no agreement. So here I am discussing which situation we have got agreement. So the relief is under section 90. But how to calculate this? So there is a formula for this. Look at this. Look. What is the formula? Doubly taxed income multiply by average Indian rate. Compare with actual foreign tax which you paid in Singapore. In my example, Shirish is getting income from Singapore. Na? So how much tax I paid in Singapore, that is one amount. Okay. And what is the other amount? Doubly taxed income into average Indian rate. See, doubly taxed income is income which is being doubly taxed. My coaching class income is not doubly taxed. Coaching class is in India only. Singaporean income is doubly. This is doubly. Why doubly? This coming from Singapore, taxed in Singapore, also taxed in India. So that is doubly taxed income. Multiply by average Indian rate. What is average Indian rate? I will not explain now. In this chapter, what is my plan? Instead of beating around the formula, it is better I will directly take one question. In the question, when figures are in front of you, you can understand the concept. Oh, this is the logic. So right now, I will not explain the concept, just by heart the formula for the time being. Trust me, once I take question number 1, I will explain the concept behind this formula and why whichever is less. Why average Indian rate, everything I will explain with logic. But wait for the sum. Up till then, just by heart this formula. But this is when there is data, and that too tax credit method. Tell me, what if India, Singapore has agreed for some exemption method in data? Then then this is not needed. Because see, in exemption method, what would have happened? That on this income, Singapore have agreed. We will not tax Shirish in Singapore. We will not tax. They have exempted. Now they have exempted. So if I have to include only in India, so I cannot cry. This is single tax. Then I will not get relief here. But in exemption method, it can be vice versa also. Singapore is taxing, India is exempting. So India is exempting, so here it will be dash. And in the bracket you will write exempt as per data, India, Singapore data. In exemption method, there are only two possibilities. Na? If Singapore is exempted, then take it in our computation. See, this computation is for India. Na? If Singapore is exempted, take it in our computation. And vice versa. If they have taxed, don't take it in our computation. But this need will not arise. Which need? Relief. This relief concept is applicable when there is a tax credit method. And for your knowledge, most of the datas of India with foreign country follows tax credit method. See, this is just one method. That's why I had to explain my students. But practically, India and foreign countries data, if you see, this is rarely followed. Most of the datas go according to tax credit method. That's why in our ICI paper also, exemption method has never come. There is no sum also in the study material. This is just theoretical. And what is there to explain in this? It is a straightforward thing, na? So in short, this was according to tax credit method. Okay. But now imagine if there is no data. If there is no data, what will happen? Look, I am changing the page now. Everything is same. Imagine now my income is coming from Pakistan. And assume between India and Pakistan there is no double taxation avoidance agreement. So see, what is Indian income? My coaching class, this is SHIRISH VYAS again. Huh? So first my coaching class income, I will write Indian income. Then this has come from Pakistan. This also I will include. And including this will hurt me. Why? Because Pakistan have already charged tax on this. And I have to again report it in India. So this is pinching me. But don't worry, at the end I will get relief. But now the relief will be called under section 91. And now the formula will be different. Tell me, if there is data, what was the formula? Doubly taxed income into average rate compared with actual foreign tax, which is less. Here you know formula is what? Look. Doubly taxed income multiply by average Indian rate or average foreign rate, whichever is lower. See, whichever is lower is there in this also. But whichever is lower between the rates, between two percentages, we have to select whichever is lower. Can't you see this, what I have written here? Average Indian rate means percentage. Then average foreign rate, rate means percentage. Is between two percentages. These are tax percentage. One is tax percentage of India, other is foreign. And then between the two, which is less. So tell me what was here? Here it is, here also which is less, but between the amounts. One amount, two amount, between two amounts, which is less. See, don't try to understand what is the concept. I am not explaining also. I told you not that first I will show you the formula mechanically. Imagine if you would have by hearted, just by heart this. Soon when I take one question, I will explain the concept that here, why do we take whichever is less between the two percentage, and here whichever is less between two percentage or two amounts. Here you know actually two amounts will be calculated. And between the two amounts, you will select whichever is less. Concept, logic, I will explain in the sum. So this is the basic theory of double taxation topic. See, this is one small question. Here I will cover all possibilities. See, I have given two cases in the question. Under one assumption, you assume there is data. Second assumption, assume there is no data. So both the ways I will solve the sum so that this thing as well as this thing, both will be covered in one question, okay? Now read the details of the sum. From the following details, compute the tax liability. See, always in the question of double taxation, they will ask tax liability. Okay, because the importance of double taxation is what? This relief. And this relief comes in calculation of tax liability, okay? And this tax you have to calculate as per old regime. Now, what are the details given? Assessee has got some Indian income and there is some foreign income. See, Indian income will not suffer double tax because if you are of India and if your income comes from India only, so it is only India who will tax you. Who is the candidate of double tax? Foreign income. So see, here Mr. X, nothing is given. We are assuming he is resident of India, but he is getting income from foreign. So foreign government might have taxed him. Plus India will also tax him. So this is precisely the candidate of double tax. We can also call this a doubly taxed income. And what is that income in foreign country? We are getting rent from house property. And see, we have already paid tax in foreign. How much? 18,000. Read this sentence. There is no standard deduction in respect of rental income in foreign country. Just like in India, for every rental income, we get 30% standard deduction under the head income from house property. In foreign country, they are saying there is no culture of standard deduction. You know, I'll tell you one thing. In these sums of double taxation, many times they will talk about what is the law in foreign, what is the law in foreign. Just ignore it. Because if you get carried away by what is the law in foreign, you will make a mess. You always remember, we are solving the sum for India. We are solving the sum for Indian government. So Indian government will go as per Indian law, na? So what is the use of this? I will come to that. But right now you should not pay attention to what is the law in foreign country. See, in this point, right, they are trying to say that only, that in foreign country there is no system of standard deduction. So what you should say? Let there be no system of standard deduction. What should I do? I am not interested. Anyways, I am filing return in India, na? And when I file return in India, my return will go in India as per Indian law. And in India, there is a custom of standard deduction. So we will take standard deduction. See, many times students, you know what they do? Because of this point, they ignore standard deduction part. See, standard deduction is not allowed by the foreign law. But you are filing the return in India, that will be as per Indian law. So in this rent income, you will take 30% standard deduction as per Indian law. Okay. So tell me, then the doubt remains, what is the use of this sentence? I will tell you at appropriate time. Right now you make a mindset that whenever they talk about what is the law in foreign, don't pay attention. What is the use of that? I will tell you at a precise time. Now, how will you solve? The question is this much only. We have to calculate tax liability. So our answer will be 5 heads of income statement and then Satak, Latak, winnings balance. So see, the answer is ready. First I will prepare statement of total income, and this is under first assumption that there is data. So tell me what will come in my income. I have got Indian income and foreign income. Indian income is how much? 10 lakhs. So this I have copied 10 lakhs. Then in foreign income I have got rent income. But against rent income we get 30% standard deduction. We will take, because this calculation I am doing for the government of India, and government of India will go as per Indian law. So see what I have done. From rent of 2 lakhs I have deducted 30% standard deduction. So what is the answer? 1,40,000. So what is my final total income? 11,40,000. This is my GTI as well as NTI, because there is no chapter 6A. It is a small question. Okay. Now after this, what to do? Divide this into Satak, Latak, Latak, winnings balance. So tell me, what is Satak G under 111A? Equity share short term on which you paid STD. But this is not there in the question, so nil. We have written nil. Then what is Latak G under 112A? Long term equity share STD paid. Even that is not there, nil. This is general Latak G, not there, nil. What about winnings? Winnings is also not there, so nil. So whole 11,40,000 will go in balance. Then calculate tax on above according to slab rates. Why? Because Mr. X is an individual. Okay. And as per old regime, means old slab rates. Tell me what is the shortcut which I gave for old slab rates? Directly apply 30% and then minus 187,500. Keep your calculator ready. Be active. So 11,40,000 multiplied by 30% minus 187,500. So what is your tax amount? 154,500. And then let's rebate under section 87A. Rebate is given when this figure is up to 5 lakhs under old regime. Under new regime, rebate is eligible. Rebate is allowed for people having income up to 12 lakhs also. But here under old regime, he is not eligible for rebate. What about surcharge? Surcharge is also not there because income is not crossing 50 lakhs. Health and education cess will come. So see, up till here your answer will always be right, provided you know the basic calculations. Now comes the main thing, relief under section 90. You know why I have written 90? Last lecture I told you, whenever we have data with that foreign country, relief is called relief under section 90. Now use this formula. Use this formula in our question. See, right now you use mechanically, then I will explain the logic na. What is the formula? Doubly taxed income multiply by average Indian tax rate. Compare with actual foreign tax paid, whichever is less. This is the formula. Do you agree? See, this formula I have written here. Look. See, this is note number 1 and I am taking you to note number 1. See, note number 1. What is the formula? Doubly taxed income into average Indian rate compared with actual foreign tax, whichever is less. So tell me how much is the actual foreign tax paid? See here. How much actual tax we have paid in foreign country? 18,000. So this is one amount. 18,000. What is the other amount? Doubly taxed income multiplied by average Indian rate. Tell me which income is doubly taxed? Income which comes from foreign is doubly taxed. Huh? So how much income came from foreign? We got income of 2 lakhs. But out of that India taxed only 140. So only 140 become doubly taxed. Huh? Tell me, will you call 2 lakhs as doubly taxed? See, feel my hand. Look at my hand. Look. This is 2 lakh and this is 140. So actual income is 2 lakhs. But what is being doubly taxed? 140 is in India also and it is in 2 lakhs also. See, what is the difference between 2 lakhs and 40, 1 lakh 40, 60,000? 60,000 is only taxed in foreign, not in India. Doubly means the amount which is double tax. Only 140 will be double tax, na? Because in 2 lakhs, if you think about 60,000 standard deduction, 60,000 has suffered the tax in foreign because they don't give standard deduction. It suffered there. But in India, it didn't suffer, na? So 60 will not get the image of doubly taxed. In short, doubly taxed will be this amount. See, doubly means what, you are being doubly taxed in India, but India is taxing only 140, na? So that is doubly taxed income. Although you might say, but I got income of 2 lakhs, but from 2 lakhs, India gave you 30% deduction. So India is taxing only 140. So only 140 is being doubly taxed. So tell me here, doubly taxed amount will be 1,40,000. Now multiply by what? Average Indian rate. You know why average? Think, why average? Look, tell me what is the problem with this 1,40,000? That it is being doubly taxed. It has already been taxed in foreign country. In fact, foreign has taxed 2 lakhs. But whatever, in that 2 lakhs, 140 is being doubly taxed. So tell me, how much India has taxed 140? See, India is giving you relief. So first India will ask you, how much have we taxed you? So can you tell me how much India has taxed on 1,40,000? Tax rate. Has India taxed 10% on this, 20% or what percentage? See, doubly taxed means who is doubly taxing? India is doubly taxing. But how do India tax you? India taxes you as per slab rate. And in slab rate, there are multiple rates. See, for 1,40,000, there is no special rate. 1,40,000 became part of my total income. And my total income is subject to slab rates. And in slab, there are multiple rates. Tell me what are the rates in slab rates? 0, 5, 20, 30. So many percentages have played the role in taxing 1,40,000. Surcharge, health and education cess. With the help of so many percentages, this 140 is attacked. In short, basically, I want you to feel Indian government is attacking 1,40,000. But at what rate? We cannot say one single rate, na? Because 1,40,000 has become part of my total income and my total income is subject to slab rate. But the problem in slab rate is what? It has got one rate or many rates. Many rates. You know actually how many percentages play role to tax you? 0%, 5%, 20%, 30%. Then in surcharge, also there are several percentages. 10, 15, 25, 37%. Health and education says 4%. So many percentages are there. That's why we take average. Basically, I am trying to convince why the concept of average. See, last lecture I just told you the formula mechanically. Now you understand the concept of average, na? Because see, our 1,40,000 is not taxed at a particular rate. 1,40,000 was included in my total income. And my whole total income was according to slab rates. And even after slab rate, sometimes surcharge can come. Health and education cess will always come. So since so many percentages play a role to attack 1,40,000, so we have to average it out. Average doesn't mean simple average. The simple average would have been what? 0%, 5%, 20%, 30%. Just add all and take the average. Simple average is wrong, right? It's weighted average. Why weighted? Because 0% is for initial 2,50,000. 5% is for next 2,50,000. 20% is on 5 lakhs to 10 lakhs. So every percentage has a different weight, na? So see, you don't have to find that detailed weighted average. Right now, you just convince yourself that average is must. And you know how to find out average? See, best way, look. Final ultimate tax divided by final ultimate income. Automatically, you will get the average percentage. Because see, do you agree? In this final figure, all the percentages have been taken care of. Tell me, this final amount has been arrived how? You applied slab rate, you applied surcharge, you also applied health and education cess. So all the percentages are taken care of in the final tax. And final tax is of total income. So just divide these two figures and you will get a percentage. Okay. You know why you have to do this? Because 1,40,000 cannot say that I am taxed at 5% or 30%. 1,40,000 is merged in my total income. And our total income becomes subject to slab rate. So tell me, what is the formula for average rate? Final total tax after health and education cess divided by final total income. They have written the formula here. Look, I have not written, but do it on the calculator. This amount divided by this, it comes to how much? 14 point how much? 0.09%. This is the average rate of tax in India. Okay. Means India doesn't have one single rate. It has got multiple rates in slabs. So average is 14.09. So multiply by 14.09. So this is the tax. Now tell me why whichever is less. See, I am doing this sum to explain the concept. Correct. See, in this two calculation, you know, what assessee will, listen carefully, what will assessee complain to government? Government, Modi government, my 1,40,000 you're taxed with 19,726. See, 19,000 is what India is taxed. The average rate is of India, na? It is the summary of all slab rate percentages. So assessee will say, India, you taxed 19,000. You are doubly taxing me. I already paid 18. Government will say, okay, you paid 18 there. The main problem is that you already paid 18. Don't pay in India. But India is taxing 19. India will tax as per Indian law only, na? Your complaint is what? The income has come from foreign, and those foreign people, they have already taken 18,000. So that is your complaint, that they have already taken 18,000. Don't pay in India. Adjust it. But give me relief. Why we will give relief for 19? 19 is the tax as per Indian law. And if you stay in India, you will have to pay tax as per India. Yes, we understand your grievance that you already paid the tax of 18 in foreign. So you paid there that much. So don't pay in India. Don't pay me. This will be allowed as a relief. It's like TDS. In TDS, what we say, some tax has already been deducted at source. So this is kind of what? Foreign people, they have already taken 18,000 tax. So don't pay that much. But now, what if this figure was 2,000? What if this figure was 2,000? Now if I tell government that government of India, I have paid 18,000 there, I have paid 18,000. You might have paid 18,000, but you have complained with us, na, that we are doubly taxing you. How much are we taxing you? We are taxing only 2,000. So that is your complaint with Indian government, na? See, basically my complaint is with Indian government. That the income which came from foreign, why India is also behind that? See, my income has originated from foreign land. So when they tax me, that's okay. But why India is also behind? So India will say that we have taxed that only 2,000. So that is your complaint. Don't pay 2,000. But I paid the 18. So that you paid to them, na? Your complaint of being doubly taxed is in India. See, basically, I am resident of India. I will fight with government of India. I cannot go and fight to foreign people. My income has come from Singapore. I will not go and fight there. For them, I am a foreigner. I stay in India. So I am fighting with my Indian government. See, actually, you don't have to fight. But imagine if I have to fight, my fight is with Indian government. And if Indian government can say, here we have taxed your that foreign income of only 2,000 we have taxed. So when you are complaining that why India is also taxing, why India is taxing only 2,000. Okay, don't pay 2,000. Okay, don't pay. Means whichever is less 2,000. But vice versa, if this is 19,000, now government will say, see, don't complain us. Your complaint is what, that you already paid the tax there. Okay, that much you don't pay in India. In short, whichever is less. And government is also smart. If they are giving the relief, they will, for them, what is better, whichever is less. So see, actually both the amounts are relevant. See, 18,000 is important because that much you have paid there. And why 19,000 is also important amount? Because this is what India has done with you. So what India has done with you and what foreigners have done with you, out of the two, whichever is lower, that much relief you will get. Okay. And see, if someone says whichever is less, government is looking at their benefit only, and why will not they say? You are getting the relief, be happy. Otherwise, the law would have been so strict. You paid the tax in foreign country, that's your problem. You stay in India, you pay tax to us. Government could have doubly taxed you, but at least government is considering that, oh, you have already paid the tax there, so don't worry, you will get the relief, but the relief will be whichever is less. And why relief is based on 1 to 40? Because only 140 is the victim. 2 lakhs is not the victim. Whereas actually my income from foreign is 2 lakhs. But victim is not 2 lakhs. Who has become the victim? 1,40,000, because India has deducted standard deduction. Only 140 got doubly taxed. And how India has taxed you? Actually India has taxed you as per different rates. So average of that comes to 14.09. So see, eventually you will have to by heart this formula. It is just we were trying to understand what this formula says. So tell me, in our sum, what is whichever is low? 19 or 18? 18,000. So where will the effect come? It will come here, 18,000. See this. See this 18,000. And after deducting 18,000, this comes to our final answer, 142,680. Okay. But you know, this was assuming there is data with that foreign country from where you are getting the income. Now, in the question, what they are saying, second case, assume there is no data. So tell me, if there is no data, how do you solve? Look here, look. Everything will be same. At the end, instead of 90, you will write 91. And the formula will be little different. So let's solve that thing. See here, case 1 is solved. Now, second case. If there is no data. So see, I am not going to solve the whole thing once again. Because up till here, it is repetition. See, whether we have data or we don't have data, till here the calculation remains same. Now, what is the only change? The formula of relief will change. So see, for second case, I have not solved once again. I am directly starting with 1,60,680. Just see this. Directly starting with 1,60,680. Till here, everything remains same. This is tax calculated as above. But now relief will be under which section? 90 or 91? 91. Now what is the formula if there is no data? What formula explains? Doubly taxed income multiplied by average Indian rate, average foreign rate, between the two rates, whichever is less. Between the two rates. So tell me, substitute the figure. First, what is doubly taxed income? 1,40,000 is being doubly taxed. Okay. Then into average Indian rate. What was Indian rate we calculated? Tell me, how did I calculate average Indian rate? Final tax figure divided by final income figure. That came to how much? 14 point? 09. So multiply by that 14.09. Now or what? Or average foreign tax rate. Then what is the tax percent? Rate means percentage. Huh? What is the tax percentage in foreign country? Let us check the question. This is the question. Have they given the tax percentage in foreign? They have not given, but we can calculate. See, foreign government has taxed 18,000 on 2 lakhs. So 18,000 divided by 2 lakhs, it will give you the percentage. Tell me why I am taking like this 18,000 divided by 2 lakhs. Are you noticing 2 lakhs is without standard deduction? Why? Because right now I am finding foreign percentage. Foreign percentage is based on foreign law. In foreign, full 2 lakhs was taxed and the amount came to 18. If you want to develop a percentage, just imagine on the income of 2 lakhs, foreign government has taken 18. So that comes to how much percentage? 18,000 divided by 2 lakhs, how much? 9%. So it will be 9%. Now between the two percentages, you have to select whicher is less. 14 and 9, whicher is less. You know here why? First see, here I have shown some working. This I have already done orally. Average Indian rate, how did you calculate? Final tax in India upon final income in India. And average foreign rate is foreign tax which you paid in foreign divided by foreign income. 9%. And now out of the two, you will take which one? Whichever is lower, whichever is less. You know here also why whichever is less? Because see, government will say, India has taxed at the rate of 14%. Foreigners, they are taxing you 9. So only 9 is being double attacked. This portion is single attack. You didn't understand what I am trying to show. See, 9 is a smaller rate. Nah. This smaller rate will get merged in 14. This is being double. This portion, see the portion which I said, this is double or single? Single. And your complaint is of double. So you cannot say 14 is double. What is double? 9 is double. Because 9 is there in foreign also and it is there inside this 14 also. Okay, so only 9 is double. So that's why multiply by 9. So what answer you are getting? 9% of 1,40,000, that comes to 12,600. So that answer will come here, 12,600. This way you will get the final answer. But now, still explanation is left. Huh? What difference it makes whether there is datta or no datta? Just notice carefully. I have not finished my explanation. Huh? See, here I did mechanically. Between the two percentages I took whichever is less. 14 and 9, what is less? 9. Multiply by 1,40,000. I get 12,600, which I have substituted here. So tell me, just notice one thing. If there is no datta, you are getting relief of 12,600. And if there is datta, you are getting relief of 18,000. What difference did you notice? See, this was in datta. Whicher is less 18,000. Here also apparently it is whicher is less. But whicher is less is between the two percentages. And because of that answer is deferred. See, here our relief is coming to some different amount, 12,600. And in the previous case when there was datta, the relief was 18,000. Can you explain why this difference? And you will always notice, if there is datta, you will get good relief. If no datta, you will get less relief. Tell me here also, if you noticed, if there is datta is what? Double taxation avoidance agreement with that foreign country, my relief is 18,000. Feel the amount is big. And in case we don't have any double taxation avoidance agreement with that foreign country, our relief is only 12,600. It's less, na? 12,600. And if datta, the relief is 18,000. Why? See, here if you see, our 12,600 was what, you know, on 1,40,000 you applied 9%. Okay. But there, 18,000 is like what, on 2 lakhs, it's 9%. Although I didn't calculate 9%, in the question 18,000 was given ready-made. 18,000 was already given. But if you do reverse working, how is 18,000 developed? 2 lakhs into 9%. That's where the difference lies. Now think further. Means if there is data, 2 lakhs into 9% becomes my relief. Okay. And there is no data, 1 lakh 40 into 9% becomes a relief. So what justification you will give? See, in both the working kind of see here I don't do any percentage working, but if I want to derive this 18,000, can't I say it is kind of like this only? 2 lakhs into 9%. See, now you can analyze better. Here it is 2 lakhs into 9% which became my relief. And in no data case, 1 lakh 40 into 9% became my relief. So tell me this means what? Here 2 lakhs into 9%, 18,000 became my relief, na? You know why? Because when we have data with foreign country, we respect foreign law. Like see, India and Singapore has got double taxation avoidance agreement. And if Singaporean laws say no standard deduction, we respect it. We respect because we have made agreement. And we respected means, okay, you people charge 2 lakhs fully without standard deduction, and at the rate of 9% it comes to 18,000. Full relief is granted, considering and respecting the foreign law. Here, foreign law is not respected. Percentage of 9 is the rate of foreign country, but the base amount is 140. Means I am not respecting foreign law because I don't have any agreement with that foreign country, na? Like our country do not have any agreement for double tax avoidance with that foreign country. So assessee cannot say, no, those foreign people, they tax full 2 lakhs. That's their problem. We don't have any agreement with them. You are person of India, we will support you, don't worry. But we'll support you according to Indian custom. To hell with the foreign custom. And why should we pay attention to foreign custom? Because we don't have any agreement with them. You understand the feeling. So see, when India do not have data with foreign law, and if people of India argue with Narendra Modi, that Narendra Modi, those people have taxed on 2 lakhs. So what government of India will say? That is their problem. We don't have any agreement with them. So don't talk what they do. Yes, we are understanding that India is doubly taxing you, but India is troubling you only 140. India is troubling only 140, no? So and that also at the rate of 9. Because here, if you see in 14 and 9, what is coming double? Only 9 is coming to double. Okay. So this is the main difference when India has data or no data. See, when India is data, and if I say, India, those foreign people, they tax full 2 lakhs. Oh, it's like that. Okay, we respect them because we have an agreement. Okay, so when we are having agreement, so we are bound by their law also, no? So that's why full 2 lakhs into 9%. See, actually for us 18,000 was given ready-made. But to understand, I have broken up 18,000 into 2 lakhs multiplied by 9% because this is where you feel the difference. Okay. See, this logic, most of the students do not know. They have by-hearted the formula mechanically. But what is the main difference between we having data or we not having? When we have data, we respect their law. And their law is taxing full 2 lakhs. Okay, according to 2 lakhs, it comes to 18. Take relief of 18. But here, to hell with their law, India is taxing only 140. So at the rate of 9%, your relief comes to only 12,600. So now do one thing. Once you understood the concept, now literally by heart. If there is data, find 2 figures, take whichever is less. Means how I remember, whichever is less between the amounts, between the actual amounts, and here whichever is less between the percentages. But the base amount will be 140 only, that doubly taxed income. Okay. Now immediately I will take one more question back to back. See, I will take one question. The last question which I solved with you, it was an extra question just to explain the concept between having data and no data. Okay. Now, question from the book, and all the questions from the book are past paper question only. Each question which is there in our book, it has already come in past paper. So see question number 1. See, in this chapter my plan is what, 2-3 questions I will solve back to back with you. Then after 2-3 sum, this will become a very stereotype sum. And at the end, trust me, at the end every student will believe in this chapter nothing is there, just by heart this formula. If no data, the formula is this, and if yes data, the formula is this. Ultimately you will have to bank on this formula only. So now try this. Read. Mr. Ravi is an individual resident in India. Generally in the question of double taxation, you will find a resident guy. Because resident people have to suffer. Because we reside in India, so India will anyways tax us. And in case we get income from foreign, they will also tax us. So residents are generally the victim of double tax. See, NR, he will be taxed in India only for his Indian income, na? But we people who reside in India, we have to pay tax in India also, and on our foreign income, foreign will also tax. In short, just notice, generally you will find a resident in the question of double taxation. Do one thing, read the last line of the sum. Read this para. Read. Compute the total income and tax payable of Ravi in India, assuming India has not entered into double taxation avoidance agreement with country S and country T. See, country S, country T, they are foreign country. ICAI, they are following one custom. They never say foreign country. They will say country A, country B. By just mentioning ABCD country, they mean to say it's foreign. And in this question, there are how many foreign countries? 2 foreign countries. Means the question which I solved right now in front of you, income was coming from one foreign country only, na? But now the income is coming from 2 foreign countries. So I am being doubly taxed because of 2 foreign countries. Question is simple. But here 2 foreign countries are giving me the income. And did you notice we are having data or no data? No data. See, India has not entered into data. So that means my formula will be, no data means doubly taxed income into average Indian rate, average foreign rate, whichever is less. Okay. Then Ravi has opted to shift out of default regime. Default regime means new regime. And you are shifting out of new regime means you are going as per old regime. Shifting out means you don't want default regime, means you want old regime. So now tell me the effect. Tell me, you have to calculate the tax and total income. Whenever the question is on, look, total income and tax, what imagination should come in your mind? 5 heads of income and then satak, latak, winnings balance. Keep that in mind. See, I have kept the answer ready for you. Look here. In our answer, we will prepare one statement of total income. 1, 2, 3, 4, 5 heads, and then chapter 6A. This is question 1 only. And then one more statement you will prepare. Statement of tax where satak, latak, winnings balance. And what will be the main attraction? Relief. Why did I write under section 91? Because there is no data. This will be the main attraction, and for this working note will be prepared. Okay. And what is the formula for this? 91. Doubly taxed income into average Indian rate, average foreign rate, whichever is less. And why I have done this working twice? Because there are 2 foreign countries giving me income. Okay. So see, first I have shown you the whole format and the template. My answer will include 1, look, 2 and 3 things. Okay. So keeping in mind what will come in my answer, let's do the marking of each item. Tell me one by one. Indian income, income from business in Mumbai. So this you will show in 5 words where? See, this is the answer, keep in mind. Where will you show this? Income from business, okay. So see, I have written here, income from business. Then what is the next income? Interest on, tell me, Indian income means what? Will this be a victim of double tax? Indian income, you are of India, you earn in India, so there will be no double tax. Double tax is for income coming from foreign. Okay. What about interest on savings bank with ICICI Bank? This will come in income from other sources. And whenever you have savings bank interest, you get 80TTA. What is 80TTA? Savings bank interest. First you include in IFOS and then you get 10,000 deduction. But if you are a senior citizen, you get 80TTB. Here you are 45 years old. You are not a senior citizen. By chance, tell me, if you would have been 65 years old, then for senior citizen also there is a deduction, but not 80TTA, it's TTB. But here he is not senior, so I will say 80TTA. And see, 80TTA is from chapter 6, na? Be careful. By chance, if the question is of new regime, in new regime, chapter 6 is not allowed. But don't worry, here the question is as per old regime, because they have said default regime, I want to shift out. So it is old regime, and in old regime, chapter 6A will be allowed. Wait, before I proceed, one most important point, please listen carefully. In the sums of double taxation, 2 topics will be very useful. Chapter 6A and concessional tax regime 115 BAC. Because in my so many years of experience, I have seen in your CA final paper, exactly where do they use chapter 6A knowledge, in such questions. Even that old regime, new regime concept they test in such question. I am talking about 115 BAC and chapter 6A. These 2 topics are most important while solving double taxation. Okay. Do one thing, write somewhere at the top. Write this, what I am saying. Write this. While in the sums of double taxation, knowledge of chapter 6A, and section 115 BAC. Section 115 BAC is must. Why did I make you write this? Because when you are preparing for exam, the moment you come across double taxation, make your chapter 6A and 115 BAC. 115 BAC is what? New regime for individuals. And one more observation, in the question of double taxation, you will always come across individual assessee. I am not saying there is no double taxation relief for corporates. Why don't they ask question on corporate? Why on individual? Because individual is subject to slab rate. And the slab rate, there are various percentages. The importance of average rate comes. What is the main charm in the formula, this average rate thing. And average gets more importance when you are an individual. Tell me, if you are a partnership firm, average rate is nothing, normal. You are subject to one flat 30%. Yes, still surcharge and all those will come. Means the protocol of finding average remains same. But it doesn't have much importance. Okay. How do you find average rate? Final tax upon final income. This formula is standard for every type of assessee. Generally, you will notice individual assessees are there. Because if the individual assessees are there, they can test your good chapter 6A points also. ATC, ATD. These are the questions where generally chapter 6A comes. Otherwise, if you expect a standalone question of chapter 6A will come, it never comes. It is always in the questions of double taxation they test you. Like see, your ATTTA knowledge was required. But if it was new regime, you won't take chapter 6A. Then, give me the effect of other things. Income in foreign country, yes. Rate of tax in foreign countries 16%. This is the foreign tax rate. See, actually foreign income is being doubly taxed. But see, right now, you should not think whether the income is Indian or foreign. Look, what did I say? Look here, look. Right now, your mentality is what? Whether it is Indian income, foreign income, just include everything in the 5 heads. That botheration will start when you do the relief formula. But initially, when you are listing all the incomes, doesn't matter whether Indian or foreign, just list in all 5 heads. So tell me, this will come in which head? Agriculture income. 5 heads of income, it comes in income from other sources. This will come in income from other sources, correct? And in income from other source, this is exempt or taxable. You know what is a common mistake here? Students say, sir, agriculture income is exempt, no? Exempt under section 10(1), no? But exempt under 10(1) if the agriculture is in India. This agriculture is happening in India or foreign land. Agriculture in foreign is fully taxable. This is a very common error. The moment you see agriculture income, what comes to your mind? Exempt under section 10(1). But that is if the agriculture income is in India. But here it is not in India, so it will be taxable. Under which head? IFOS. See, I am classifying the income into various heads. What about royalty income? Royalty from a book on art from country S. Royalty income comes where? Income from other sources. See, I want to classify in 5 heads. See, don't forget my answer is what? This is the template of my answer. So, where I will show income from other sources. But, for royalty income, there is one ATQQB, RRB in chapter 6A. We already done chapter 6A. So, in chapter 6A, what is ATRRB? If royalty comes from patents. If it is from books, it is ATQQB. And this is royalty from books. Okay. So, ATQQB will come. What is the deduction in ATQQB? 3 lakhs. Up to 3 lakhs you can get deduction for royalty income if it is from books. But see, you incur some expenditure for earning the royalty. So see, whenever against some income there is connected expense, you can deduct. So this will come in deduction. This expenditure will come in deduction. So tell me, after deduction, what is my net royalty? What is my net royalty? My net royalty is 7,30,000, which will first get included in IFOS and then in chapter 6L minus 3 lakhs. 3 lakhs is a limit under ATQQB. See, all this thing doesn't strike. See, although the question looks like of double taxation, but importance of double taxation is only in this much. Look, only when you have to apply this formula. But most of the things are based on general principles. Here they will test your general income tax knowledge. Because this knowledge will be useful at the end. But if you want to reach at the end, you have to travel through the whole computation where your basic knowledge will be tested. Then tell me the next point. Income from foreign country T. Dividend from country T. Dividend income, where does it come? 5 heads of income. Which head? Income from other sources. Okay, then rent from house in country T. This comes in which head? Income from house property. But below see what is given. Municipal tax paid in respect of house is not allowed a deduction in country T. Means in country T you don't get deduction for municipal tax. In India we get So tell me, I should pay attention to foreign law or I should go as per Indian law? As per Indian law. Because see, the main computation which you are going to make, this main computation you are doing for filing return in India. So when the computation is made for Indian government, obviously you will go as per Indian law. So don't pay attention to this, that in foreign country you don't get deduction for municipal tax. Let them not give. I am right now filing return in India, and while I file return in India, I will file as per Indian law. So we will take deduction of municipal tax. Here I have written deduction. Tell me what will be income from house property finally in our question. From rent, First you subtract municipal tax, then you subtract 30% standard deduction. See, income from house property they have not kept in CA final syllabus. In the whole study material, house property income is not there, but they expect some basic knowledge. Under house property, what we do, from the rental income, first to subtract municipal tax. You know, if you remember, CA enter gross annual value minus municipal tax, net annual value, then you take 30% standard deduction. So tell me what will be house property income? 3,30,000 minus 10,000. Then 30% standard deduction. So this is done. Now let us put all this in the answer. So tell me, in my answer, first what I will write? Income from salary. Check one by one. See, even if not there, I have purposely written all heads of income. It is better to check head wise. So do we have salary income? No. So I have put nil. Do we have income from house property? Yes. Where? Here. And see, while arranging the 5 heads of income, please don't bother whether income is coming from India or foreign. Mix all the incomes together headwise. So see, just check, do we have house property head? We do have. So calculate the amount fast. Keep your calculator ready. 3,30,000 minus 10,000 minus 30% standard deduction. So 3,30,000 minus municipal tax minus 30% standard deduction. So that comes to how much? 2,24,000. Go headwise. Next head is income from business. Check in the question. Do we have income from business? We do have 4,40,000. So transfer here 4,40,000 income from business. Then do we have capital gains? In the whole question we don't have anything from capital gains. So capital gains will be 0. Nil. Then in income from other source, what do we have? Check in the question. Which items we have in income from other source? We have got interest on savings bank, then agriculture income from foreign, royalty income and dividend income. How many incomes are there? 1, 2, 3 and 4. 4 items in income from other source, in which royalty income has got some expenditure also, which you will deduct. Okay. So I will directly show you those 4 items. Look here. Interest on savings bank account, how much it is? 14,000. Then what was next? Agriculture income from foreign. That was 94,000. Then we had royalty income. Royalty income, see how I have shown. 780 minus 50,000 connected expense. So that comes to 7,30,000. And then there was one more income. What was that? Dividend from country T. So this is all under income from other source. In short, see, question will be given in haphazard manner. You have to arrange it headwise. And then what is the gross total income? 17,95,000. And in chapter 6A, what we have? We have 2 things, ATTTA and ATQQB. ATTTA, what is the amount? 10,000. And what is ATQQB? 3 lakhs. ATTTA 10,000 and ATQQB 3 lakhs. 3 lakhs is the fixed amount in ATQQB. But you know, if you remember, in chapter 6 there was a rule that if royalty comes from foreign country, you have to bring the foreign currency in India. Then only you get deduction. And here I am getting royalty from foreign country only. This was a condition in ATQQB that if royalty comes from foreign country, it should be brought in India in convertible foreign exchange. This thing is not given in the question, so I am assuming it is brought to India in convertible foreign exchange. That's why I am taking the deduction of full 3 lakhs. By chance, if they say that this royalty was not brought in India, it was not brought in India, then you won't get deduction of 3 lakhs. I have taken deduction of 3 lakhs assuming royalty which is earned in foreign land, it is brought to India in convertible foreign exchange, and you know there is a time for bringing within 6 months from the end of the previous year. So this I taught in the topic of chapter 6A, you know. Then what is the final NTI? Final NTI is 14,85,000. After this, what to do? Satak, Latak, Latak, winnings balance. So look here. Do we have Satak G under 111A? Not there. Latak G not there. Latak G not there. Winnings, no, nothing is there. The whole amount will go in balance. What was the answer? 1485. 14,85,000 will go in balance. And here I will apply the slab rate. Which slab rate? Old or new? Old slab rate. And what is the shortcut for old slab rate? Directly apply 30% minus 187,500. So that comes to how much? Give me the answer fast. 2,58,000. Surcharge comes if NTI is above 50 lakhs. We are not above 50 lakhs. So no surcharge. Health and education says 4% will come. Then till here the answer is normal. Now relief under which section? 91. Why did I say 91? Because there is no data. So what is the formula of no data? Doubly taxed income into between the two rates, whichever is less. So we'll do one thing. First we'll find out the two rates. See, first I will figure out this thing. Average Indian rate and average foreign rate, whichever is less. So give me the answer one by one. What is average Indian rate? Look here. Here only you will get the answer. Look. Your final tax divided by final income. See, I am stressing your final means what is final tax after health and education says? The ultimate tax liability divided by your total income. So what is the percentage? It comes to 18.007%. So see, I have shown the working here. Wait, 18.07%. So see, I have written here 18.07%. Look. And here also 18.707%. Now what is average foreign rate? It is directly given in the question. And see, in foreign there is only single tax rate. And if the tax rate is single, there is no importance of average. See, although in my formula what I have quoted, average foreign rate, but average importance comes when there are multiple tax rates. But here in the question, in country S, country T, the rate is multiple or single rate? Single rate. So that itself becomes the average foreign rate. So 16 and 20. So see, I have written here, look, 16 and 20. Now between the two rates, you have to select whichever is less. So what is less here? 16. That's why I have highlighted with red color. And here what is less? 18.07. Now, trust me, doubly taxed income, your students make most of the errors. You try to find out first what amount will come here, what amount will come here. Eventually, you will multiply by this percentage. Tell me, what do you mean by doubly taxed income? Income which is being double taxed, and it is only the foreign income. You know, now look at me. Now my eyes will be only on foreign incomes. Look. And always find out from the answer. If you try to find out the doubly taxed income from the question, you will always make a mess. See, fix certain rules. Whenever you want to search, what you want to search? What? Doubly taxed income, you have to search the answer. And there also you have to search foreign income, because it is the foreign income which has become the victim of double tax. So see, I'll go country wise. First let us focus on country S. So see, country S, let me highlight. Where is country S? Country S. This is country S. Country S. You can check if you want. Check. Which incomes have come from country S? Which income? Agriculture income and royalty income. Do you agree? Where this rent has come from? Country T. Okay. And dividend has also come from country T. So from country S, which income has come? Country S. It is agriculture and royalty, which is being doubly taxed. Now, doubly taxed income should always be calculated as per Indian law. Because we are blaming Indian government that you are doubly taxing me. So Indian government will doubly tax you as per Indian law. So tell me, as per Indian law, full 94 has been taxed. But royalty, India is not taxed fully. They have granted you 3 lakh deduction. So you cannot say full royalty has become the victim of double tax. See, 7 lakh 30 you have to report in India. But India is giving you 3 lakhs deduction. You should value that. So can you complain India that you are taxing 7 lakh 30 double time? India will say relax. We have included your 730 which has emerged from country S, but we have not taxed full 730. We gave you 80 QQB deduction of 3 lakhs. So how much is doubly taxed? Find out 730 minus 3 lakhs, 4 lakhs. See, in doubly tax you have to see the final computed figure. See, plain royalty which came from foreign was 780. But there was some expenditure. In India, there is a culture of deducting expenditure. So after deducting the expenditure, it's 730. Then in India, there is a culture of chapter 6 also for royalty. So deduct that also. See, India will have sympathy for what? For the amount which is being double. You cannot say full 780 is double. From 780, India allowed 50,000 expense. Then they allowed chapter 6A. Yes, balance has remained in your income. That is doubly taxed. These things are important. See, didn't I say some time back, doubly taxed income is the only main charm in the sums of double tax. So tell me, firstly, now can you tell me why did I say don't search it from the question? Because see, for doubly taxed income, if you struggle to find out from the sum, you will not have that insight of chapter 6 etc. Right now, see what did I do? For royalty, didn't I say from 730 you have to subtract this also? All this insight you will get when you look in your answer. So set certain protocols. For doubly taxed income, look in the answer. And look which income? The income which has come from foreign. See what I did? I highlighted country S. And there also you have to see according to Indian law what India has done. So for agriculture income, full 94 India is taxed. So full 94 is doubly taxed. But royalty, although it was 780, but India gave you deduction, then it became 780, then India further gave you chapter 6A, then it further reduced. So net amount is doubly taxed. So finally what is the doubly taxed amount? 94 plus 730 minus this 3 lakhs. So give me the answer. Look here. Agriculture 94 and see royalty amount how much I have written. 730 minus 3 lakhs, that comes to 4 lakhs 30,000. So what is the final figure which is doubly taxed? 5 lakhs 24,000. See, this is the formula and the main hero of the formula is doubly taxed income. Percentages students can easily find out. Okay. So now tell me what is the relief for country S? 5 lakhs 24,000 into whichever is less is 16%. So that comes to how much? 83,840. Now try for country T. Now it's a repetition. In country T, I want to know which income is doubly taxed. So firstly look, my eyes will be in the question or answer. Answer. So see, I will take you to answer. And in answer, my eyes will be on country T. Search country T. Search country T. See this country T. Then country T. Where else you have country T? So there are only two incomes coming from country T. So tell me what is the first income coming from country T? Rent of house. Now if someone says, but in country T from rent you don't get municipal tax deduction. It was given in the question. And in foreign there is no culture of standard deduction. See, that they didn't mention, but standard deduction culture is of India. In country T, from where you got the rent, municipal tax is not allowed. So tell me, will you pay attention to what foreign is doing? Doubly taxed income should be calculated as per Indian law. See, although in foreign your full 3,30,000 was taxed, but what will India say? 3,30,000 was taxed in India. We gave you municipal tax deduction. We gave you standard deduction. And we are taxing only 2,24,000. Only 224 has become the victim of double tax. See, doubly taxed income should be always as per Indian law. See, here if you think in rent, foreign, they don't give municipal tax deduction. They are not giving. But you are being doubly taxed in India. So think as per Indian law. So tell me, as per Indian law, how much rent is being doubly taxed? 2,24,000. Whereas my actual rent is 3,30,000. But India is taxing only 224. So only 224 become doubly taxed. Then what other income you have from country T? Dividend. That is 2,65,000. So these two figures becomes doubly taxed income of country T. 224 and 265. Remember the amount. Huh? One is the rent, which is 2,24,000, and other is the dividend, which is 2,65,000. What is the total? 4,89,000. This is the doubly taxed income. Multiply by whichever is lower. What is lower? 18.07%. So that comes to how much? 88,362. This becomes the amount of relief. Now what to do? This is the relief of country S. This is the relief for country T. So add both the reliefs. Add. So what is the total relief? Add. They have shown the addition here. 172,202. This I will write in the main answer. What was the amount of relief? 172,202. This is final relief under section 91. Okay. And then tax payable will be 96,118. Okay. And then, whenever your tax payable doesn't have last digit 0, you should round it off to nearest 10. So if it is 118, it will become 120. So this is a rounded off figure, 96120. In short, see, the whole question is normal. The most important thing is doubly taxed income. You can write somewhere, doubly taxed income should be calculated as per Indian law. Means if Indian law gives you chapter 6A for royalty, consider that also. See, what India is doing is doubly taxed. Okay. Actually, if you see my printed book, original notes, there I have written this also. I have given in the notes also, doubly taxed income working should be as per Indian law. Because you are claiming relief from India. So you have to ask how much India has doubly taxed you. So it will be obviously as per Indian law. So this was question number 1. So now see, read in question 2. Firstly, read the last line. What was given? Compute the total income and the tax payable of Mr. Praveen as per the default tax regime. Default tax regime means it is as per the new regime. And you have to calculate total income and tax. See, one thing is fixed. Whenever the question is on double taxation, they will always ask you total income and tax calculation. Okay. So what will be our target? First we should identify whether India is data or not. And then whatever details are given, you will have to classify into heads of income. Means we will have to decide which income belongs to which head. So see, firstly, in the first paragraph only it is given, India does not have double taxation avoidance agreement with country Y. So if there is no data, relief is under section 91. Formula doubly taxed income into lower of Indian rate and foreign rate. So tell me one by one which income belongs to which head. Firstly, in income in India, gross salary 70,40,000. This will go to IFS, income from salary. Then interest on savings bank account with SBI. This will go to income from other source. But whenever there is savings bank interest, it should remind you of 80 TTA. 80 TTA. But 80 TTA is an item of chapter 6A. Chapter 6A is not allowed in new regime. So here we have to solve the question as per new regime. So chapter 6A not allowed. So see, although I have written 80 TTA, but then I have put a cross mark there. Then dividend income from Indian companies, this will come in income from other sources. Now they have given list of income coming from country Y. See, while you are deciding heads of income, you don't have to bother whether income is coming from India or foreign country. Okay. Right now, all incomes are one and the same for us. Simply classify into respective head. Next income, see, gift from a friend not taxed in country Y. Is what they are saying. Gift is not taxable in foreign country. But that is foreign law. What did I say? We are solving the sum for Indian government. So we will be solving the sum as per Indian law. In India, what is the law? Whenever you get a gift from a friend, if the value exceeds 50,000, it is taxable. So we will go as per Indian law, and as per Indian law, receiving gift from a friend, that too of 90,000, which is more than 50,000, it will be taxable. Under which head? Income from other sources. But then since this gift is not taxed in country Y, this has not suffered double tax. So when you are measuring doubly taxed income, this will not be counted, because doubly taxed income is income which is taxed double time. But this income is taxed only in India, not in foreign. So it cannot be called as doubly taxed income. Okay. Anyways, right now, while preparing the 5 heads of statement, 5 heads of income, I am keeping in mind Indian law, and as per Indian law, gift is taxable. Then dividend income. For dividend, what they are saying, this is taxed in country Y. Means in country Y it is taxable. Okay, let it be taxable. Right now, what is the law in India? In India, the law for dividend is taxable. Even this will come to which head? Income from other sources. Then rent from house property, even this is taxed in country Y. Okay, means right now we have to think from Indian law. In Indian law, what is rent of house property? Income from house property. This will come in IFHP. But municipal taxes in respect of above house is not allowed as deduction in country Y. See, this is a law of foreign country. But again I repeat, when we are preparing the statement, we will prepare as per Indian law. And Indian law, municipal tax is allowed as deduction. Even standard deduction will be allowed for rental income. Okay. Then business loss. What they are saying, it is not allowed to be set off in country Y. So this is a law of country Y that they don't allow set off. But again I repeat, when we are preparing the solution, we are preparing for India. So we will go as per Indian law. And in Indian law, business loss is allowed to be set off or not? It is allowed. We can set off business loss anywhere except income from salary. So we will go as per Indian rules. So this we will say it will be allowed as set off. See, I have written set off. Set off anywhere except income from salary. Then royalty from writing articles in journals. And they are saying this is taxed in country Y. Anyways, right now I am thinking about Indian law. In India, what is the law for royalty? It is taxable under income from other sources. So this will come in EFOS. But then for royalty income, there are 2 sections in chapter 6A. 80 RRB is royalty from patents. 80 QQB is royalty from books. None of the section will fit in this question, because RRB is for royalty from patents. This is not patent royalty. And 80 QQB is royalty from books. And this is books royalty or writing articles in journal. Writing articles in journal. See, when you write some articles in journal, that means you have not written a book. When you write some book, royalty income can come in chapter 6 80 QQB. Or if it is some patent, 80 RRB. But in this question, neither 80 QQB will fit nor 80 RRB will fit. Even if these sections were fitting, I would have ignored, because we are solving the sum as per new regime. And under new regime, chapter 6A deductions are not allowed. But still, by chance, if the question would have been as per the old regime, then we take chapter 6A, na? And what is the common mistake of a student? Students take this royalty in 80 QQB. The 80 QQB is for writing books. And here we have not written book, we have written some articles in the journal. So this is plain income from other source. Then in country Y, the tax on dividend is 10%. And for all other income, 20%. So this shows in country Y there is single rate of tax or there are two rates. There is single rate or two rates. So we will have to find out the average. See, last lecture if you remember one question which I solved, question number 1. There they had given one single rate only. So that rate itself became the average rate. But in this question what was special? That in country Y there are two rates. So we'll have to find out the average rate. And here average doesn't mean simply take 10 plus 20 divided by 2. That is not a simple. You don't have to do simple average. Average foreign rate, how will you find? Total foreign taxes divided by total foreign income. Total foreign tax divided by total foreign income will become your average foreign rate. And why I want average foreign rate? Because in this question there is no data. And when there is no data, we compare Indian rate and foreign rate, whichever is lower. So we have discussed all the items. Now check the answer. Question number 2. Wait. See in our answer, firstly you should imagine 5 heads of income will come, and then at the end chapter 6A. So tell me headwise. See, whenever you are solving this sum, you should not go as per the sum. You should go as per our system. Our system says go headwise. So go headwise. So first you should always think of income from salary. Do we have income from salary in the question? We do have. How much? 17,40,000. But against salary income you will provide standard deduction. And what is standard deduction? Under old regime 50,000. Under new regime 75,000. Here it is according to new regime. So you will provide 75,000 standard deduction. You know under new regime standard deduction is 75,000. So your salary income is 1665. Then income from house property is also there in the question. What was the rent amount given? 3 lakhs. From that you will subtract municipal taxes and you will also subtract standard deduction. So that comes to 3 lakhs minus 30, 2 lakhs 70 minus 30%. So what is HP income? 1,89,000. Then income from business. Do we have income from business? We have business but not income. We have business loss. And where to set off business loss? You can set off anywhere but not against income from salary. If I want, I can set off against income from house property also. See, what is the amount of business loss? 1,60,000. If I want, I can set off against HP income also. But I have preferred to set off this against income from other sources. You can do anything. Marks will be awarded for anything you do. Because actually we have a freedom to set off business loss anywhere except salary. But in this question, I have not set it off against HP income. I will set off against IFOS. But here I will write nil because from income point of view, there is no income. We have business loss. What about capital gains? Even capital gains is not there in our question. Then in income from other source, what items we have? Just count and tell me. Look, we have interest on savings account 1, dividend 2, gift 3, again dividend 4 and royalty 5. So we have got 5 items in income from other sources. So check one by one. First is interest on savings bank account, then gift from friend 90,000, then royalty 2,20,000, then dividend from Indian company 10 lakhs, then one more dividend was there from country Y. So these are the 5 income from other source item, and against this I have set off business loss. See this, which alternatively you could have set off against income from house property also. Okay. So after all this, what is the GTI? 32,84,000. Okay. See, those who are watching video lecture, please make sure that you first solve the homework and then you attend the solution lecture. Because you know why I'm making this announcement repeatedly? Because these days I'm noticing there are many students who just call me for some doubts, and when I ask them, are you solving the sums on systematic basis? Sir, no, I am not able to get time because I watched the video while traveling. They have some reasons or the other. See, reasons are valid, but because of valid reason, you cannot do something wrong. Na? What is wrong is wrong. There is no excuse for wrong. So please make sure that you first solve this sum and then you see the solution lecture. Okay. Then in chapter 6A, nothing will come because new regime chapter 6 is not allowed. Actually, there was one item which was eligible, ETTTA, but I will not take because of new regime. Then what is the final answer? 32 lakhs 84,000. After this, you have to prepare that Satak Latak winnings balance. So see, we don't have anything from Satak Latak winnings. So whatever income is there, it will go to balance column. And on balance column, you have to apply slab rate. But which slab rate? Old regime or new regime? New regime. Tell me what are the slab rates under new regime? All these slabs are of 4 lakhs. 0 to 4, 4 to 8, 8 to 12, 12 to 16, 16 to 20, 20 to 24, and then about 24. And all the percentages are increasing by 5%. And here also there is one shortcut. Whenever your income under new regime goes in the last slab means about 24 lakhs. You know what is the shortcut? Directly multiply by 30% and deduct 4,20,000. You just have to remember 4,20,000. 4,20,000. This shortcut will save your time, na? Otherwise, you will be struggling in 0 to 4 lakhs, 4 lakhs to 8 lakhs, 8 lakhs to 12 lakhs. And many times in our exam, the income is so big. It is in the highest slab, 30%. See, shortcut applies only when the income is in the highest slab. Huh? Tell me what shortcut I gave for old regime. Under old regime, directly multiply by 30% minus 187,500. And under old regime, if you are in 20% slab, directly multiply by 20% minus 87,500. And they were the shortcuts in old regime, but not for senior citizen. Huh? Under new regime, the slabs are common for junior, senior, everyone. And here the shortcut is directly multiply by 30% minus 4,20,000. So see how fast your answer will come. You can calculate on your calci 32 lakhs 84,000 multiplied by 30% minus 4,80,000. Answer comes to 565,200. Then surcharge will not come because surcharge comes only when your income is exceeding 50 lakhs. Here it is not exceeding 50 lakhs, so no surcharge. Health and education says 4%. Then this is the main part of the answer. Relief under section 91. Why did I write section 91? Because we don't have data with that foreign country. Now, what is the formula for relief? See, I have written the formula. Doubly taxed income multiplied by average Indian rate, average foreign rate, whichever is less. So we'll do one thing. First we will calculate the rates. That is simple. And then the most important part is how to calculate doubly taxed income. Okay. So first tell me, how will you find out average Indian rate? You have to compare what? Final tax after health and education cess divided by final income. See, our final tax is 587,808 and our final income is 32 lakhs 84,000. Divide this and get a percentage. So what is the percentage? See, I have written here 17.9%. So this is average Indian rate, 17.9%. And how to calculate average foreign rate? Total foreign tax divided by total foreign income. So now we'll have to figure out total foreign incomes. So tell me in this question, what foreign incomes we have? Here only we can see, look. What are the foreign incomes? See, this is a list of foreign incomes. You know what we are finding? Listen carefully now. Foreign rate means foreign tax upon foreign income. But now we will go as per pure foreign law. Why? Because right now my objective is to decide the tax rate of foreign country. And obviously tax rate of foreign country will be based on foreign law. See, when we are preparing the main answer, look, this 5 heads, that time our mentality is what? This I am doing for government of India, so I will go as per Indian law. But right now, see what I want to do. I want to find out the tax rate of foreign country. See, many students think, sir, tax rate of foreign country is given on dividend 10%, other income 20%. But there are two different rates. Huh? We want average. And now I will go purely as per foreign law. See, one thing you can by heart, look. When you should go as per foreign law, you know, Look at this. Wait, whenever you want to find out the average foreign rate, and one more place, look, actual foreign tax, then only you have to see the foreign law. Nowhere else you will have to pay attention to what is the law in foreign. See, what is the law in foreign means? Don't they say in the question, in foreign municipal tax is not allowed, gift is not taxed, blah blah blah. So when to pay attention to the foreign law? Literally you can by heart. One is when you want to find out how much tax you paid in foreign. Obviously, how much tax you pay in foreign depends upon foreign law. And one more place here, if you want to find out the average foreign rate, here also you have to go according to foreign law. So currently in the question we are figuring out average foreign rate. So let's see, for average foreign rate, see what I have done. I have written all the foreign incomes here and I have written all the taxes on that. And then this divided by this will give me 1%. Okay. So tell me in our question, what incomes we have from foreign? We have gift, but that is not taxed in foreign. And now I am strictly going as per the law of foreign. So I will ignore gift. Then what other income you have in foreign? Tell me fast. You have got dividend income. You have got rent income. What else? You have got royalty income. Business loss is a loss, na? Okay. So from income angle, which incomes are there in foreign? Dividend, rent and royalty. Do you agree? Dividend, rent and royalty. Remember, dividend, rent and royalty. See, dividend, rent and royalty. And the figures I will write as per foreign law. So tell me, what is the dividend amount? 2,30,000. So I will write 2,30,000 here. And then what is the rent amount? Rent is actually 3 lakhs and their municipal taxes are not allowed. And even standard deduction culture is of India, not in foreign. So municipal taxes, rent of house property is 3 lakhs. I will take 3 lakhs only. Are you noticing I am not going as per Indian law? When you are preparing the main statement of 5 heads, you go as per Indian law. Right now, purely as per foreign law. In foreign, rent income is directly taxed full 3 lakhs. So see, I have written here 3 lakhs. And then there is royalty income also. See, if by chance for this royalty income, look, if by chance for this royalty income, India would have given chapter 6A, like 80 QQB, blah, blah, blah. So that is Indian law. Even that you should ignore. See, right now I am calculating foreign tax rate. It is purely as per foreign law. And in foreign country, they might not be giving 80 QQB, na? In foreign country, royalty would have been taxed straight at full amount without chapter 6A. It is the culture in India to provide 80 QQB. And again I am repeating, in this working, don't go as per Indian law, go as per foreign law. Now tell me, what is the tax rate on dividend income? Dividend 10%, for all other income 20%. So see what I have done. Dividend 10%. All other income 20%. So apply the tax rate. See, this is the percentage given in the question. Multiply the percentage by the income, you will get the amount of tax. So now I will get the total tax and this is the total income. So this upon this, divide and you will get a percentage. So that comes to how much? 16.93%. 16.93%. You understood how did I get? Total foreign taxes divided by total foreign income according to pure foreign law. Okay. So 16.93 where I will write? Here. Now between the two rates, whichever is lower you have to select, that is 16.93. But this you have to multiply by doubly taxed income. Now tell me, for doubly taxed income, what did I say in the last lecture? You will search this from the question or our solution. Our solution. Okay. Because these amounts should be the computed figures. And computation we have done inside the solution. So now my eyes are in on the solution. Look. And here also tell me, in the solution there are so many things. My focus will be on foreign incomes. Because who is the victim of double tax? Income coming from foreign. So see what I am doing. Look here, look. Look here. All foreign incomes I am highlighting here. Look. Can you see I am highlighting it? All the foreign incomes. Anything coming from country Y I have highlighted. See this here I want to show you should focus on what is coming from foreign country. Now tell me one by one, you tell me whether it will be covered in doubly taxed or not. Okay. So answer first point is rent income. This is doubly taxed, yes. But full rent of 2 lakhs, 3 lakhs is not doubly taxed, only 1 lakh 89. So you might have paid tax on rent of 3 lakhs in foreign country. But India is taxing only 1 lakh 89. So only 1 lakh 89 become doubly taxed. Again, doubly taxed income is according to Indian law, because India is doubly taxing you. So we will see as per Indian law. So this is one amount. Then what else? Just see that highlighted thing. What else has come from country Y? Gift. But gift is not doubly taxed. So gift I will not take, because gift is taxed only in India, not in foreign. So it is not doubly taxed. Then what else? Royalty income. But you will take after chapter 6A if any. But this royalty was without chapter 6A because it is new regime. Na? Then what else is there in doubly taxed? Dividend income. Okay. So see, do you agree these incomes were taxed in foreign also and it's taxed in India also. But India has given set off of loss also. And that loss is also pertaining to country Y. So adjust that. See, doubly taxed income is according to Indian law. See, basically, we have to think, you know what, how India is taxing those foreign incomes. So tell me, what is India doing with foreign income? They are taxing 189. They are not taxing, sorry, they are taxing 189 and they are taxing royalty. They are also taxing dividend, but that is after set off. See, India is also giving you set off now. Now someone will say, but that set off is not allowed in foreign country. But why are you seeing foreign law? Doubly taxed means how India is doubly taxing you. And when India is giving you set off, so you cannot blame Indian government that you are doubly taxing me. They are giving a set off also, na? So tell me, what is the final doubly taxed income amount? 1,89,000. And gift I am not taking, you understood that, na? Gift I am not taking because gift is tax free in foreign, so it's not double tax. Then royalty will come, dividend will come, and even set off will be provided. So if you can calculate, it comes to how much? See here. First is rent income, 1,89,000. Then royalty. Then dividend. Gift I have not taken, because gift is singly taxed, not doubly taxed. Business loss I will adjust. See, are you convinced with adjusting business loss? Because India might be doubly taxing your foreign incomes, but India is also providing you set off, na? So to that extent, India is taxing less. So doubly taxed income is 4,79,000. See, if a student can successfully calculate doubly taxed income, 99% his answer will be fully correct. Then 4,79,000 into 16.93%, that comes to 81,095. This is relief under section 91. This will come here. Relief under section 91. And then what is the final amount payable? 506,713. So this you can round it off to nearest 10. Last digits are 713. So it can become 710. So 506, 710. So this was the answer to homework question number 2. Okay. Now see, proceeding further in this topic. Now see, question 1 and 2 which we solved, there we found foreign income but expressed in Indian rupees only. But then the reality is, if the income is of foreign, originally the income is originating in foreign currency. So now in the upcoming question you will find income from foreign country is given, but it is expressed in dollars and pounds. So we have to understand how to convert it into Indian rupees. Tell me why to convert? Because this answer we are preparing for filing return in India. And in India, we will file the return in Indian rupees. So although my original income which is coming from foreign is actually coming in dollars and pounds, but here I will write in rupees. So the question is how to convert those dollars and pounds into rupees. So see, for this, there is one rule, rule number 115. Okay. Wait, before that, one more thing. Look here, look. This I will explain. Wait. Tell me the question which I did right now. Here, what was given? India does not have data. Tell me, by chance, if India is data, what will be the change in the answer? It was not asked, I want to discuss extra. Means, original question says India does not have data. But just imagine what if India would have data with that foreign country. Then what your formula would have been? Doubly taxed income, which we already calculated. Okay, multiply by average Indian rate, compare with actual amount of foreign tax, then whicher is less. To find out the answer, look, I have written the formula. If India would have had a data, then look, doubly taxed income into average Indian rate, that is one amount. And then you compare with actual tax which you paid in foreign. And this I have already calculated here. See, what is the actual tax which you have paid in foreign? 1,27,000, which we calculated already. So compare and see whichever is less. So what is less? 85,741. Means you would have got relief of 85,000 something. But we actually got relief of only 81,000 something. We got less relief because we didn't have data. See, basically by this extra discussion, I want to reinforce one point. That whenever we have data with the foreign country, our relief amount will be bigger. See, you can check the answer only. Last lecture also I convinced that. Once again I am reinforcing the point. See, if there was no data, we got relief of only 81,000 something. And just imagine if India would have had data, then the relief would have been 85,000 something. It would have been more. Anyways, this thing I have done as extra working only. It was not asked in the question, just an extra working. Now let us come to the new thing. There is one rule 115 which explains how to convert your foreign income which is there in dollars and pounds into Indian rupees. So see, for each head of income the rules are different. So see one by one. If you get salary income from foreign country, everywhere you imagine income is coming from foreign country. So imagine if you are getting salary from Dubai, Australia, Singapore, then your actual salary is in foreign currency. How will you convert into Indian rupees, you know? Preceding month end rate. Preceding month end rate. You know why month end? Because salary accrues from month to month. Tell me, whenever you do job somewhere, you get salary on monthly basis. Like April, May, June. So each month's salary you will convert into the rate of exchange of not that month, preceding month. Like if my salary is of June, I will convert according to the rate of exchange of not June. What is the preceding month? May. That also 31st May. The rate of exchange keeps fluctuating every day. So we have to select which day? Preceding month end. We have written month end rate. But see, when I say month end, not literally that same month, preceding. Here I have mentioned. Preceding the month in which salary is due. So for example, if my salary is of December month, which rate of exchange I will take? Rate of 30th November. Preceding month end rate. Then, first I have shown salary. Now directly I will go to capital gain. See, this red things has got some special rule which I have written in red. So right now focus on the blue incomes. Capital gains. Can you guess how will you convert capital gains? The month when you transfer the property. Like for example, you transfer the property in the month of August. So August, you transfer the property, that means capital gains arose in August. So what is the month preceding August? July. Preceding August, what is the preceding month? July. So 31st July rate of exchange you will take. Here again the rule is month end rate. But which month? Not that month when capital gain arose. Preceding month. Preceding which month? The month when asset was transferred. Because see, capital gain arises whenever there is a transfer of a capital asset. Okay. Then interest on securities and dividend income. Even though these two income will go according to month end rate. Like see, interest on securities, generally interest on security falls due on a particular date. Like in debentures, you might have heard debenture interest you get on 30th June and 31st December. Many times you see this in accounts questions that debenture interest falls due on this date and this date. So whenever it falls due, not that month, preceding month. In short, everywhere it is month end rate, month end rate. I had month end, month end, month end. But which month that you can logically think? For interest on security, which month becomes important? The month when interest becomes due. But you will not take that month preceding. See, although I am repeatedly saying month end, month end, month end, but again remind yourself not that month, preceding month. And for interest preceding which month? Whenever the interest became due, preceding that. And if the question say interest becomes due on 30th June, so what is the preceding month? 31st May. See, preceding the month when interest is due. And for capital gains, preceding the month when the asset is transferred. And for salary, preceding the month when the salary was due. Then, tell me for dividend, again there is month end rate. But which month will be taken as base for dividend? You know how dividend income is taxed? It is taxed on declaration basis. Once dividend is declared, you have to pay the tax. But that is for final dividend. Interim dividend is taxed on receipt basis. Final dividend is taxed according to when it is declared. Like say if some company has declared the final dividend. So once it is declared, it will become taxable. It is not on receipt basis, it is on declaration basis. And how about interim dividend? See, interim is not planned, suddenly you get. So that is taxed on receipt basis. So depending upon which dividend it is, if it is interim dividend, receipt basis, so whichever month you receive, preceding that month. If you receive the dividend in September, so what is the preceding month? August. Means here also the rate is month end rate. But which month? Preceding the month when dividend is received. Received if it is interim. If it is a final dividend, the month when dividend was declared. See what I have written here. Preceding the month when the dividend is declared or received. Tell me why I have written two things, declared or received. That depends upon what type of dividend we are talking about. Na? See, generally if the question is silent, we have to assume it's a final dividend. And for final dividend, which month becomes the base? The month of declaration. But you will not take the rate of exchange of that month. Huh? Every time you have to take the preceding month. In short, see, you can generalize. All the incomes you have to convert according to month end rate. But which month? Not that month, preceding month. But three incomes have a different rule. Which three incomes? House property income, business income, and other items of EFOS other than interest and dividend. So see, business income is converted according to year-end rate. Because see, business you do throughout the year and profits are computed monthly or at the end of the year. At the end, business income means what? Profits. And when do you calculate profits? Do you calculate profits every month? No. Profits are computed at the end of the year. So that's why year-end rate is important. Okay. Even for general items of EFOS. General means other than interest and dividend, you will go according to year-end rate. You know one weird thing in the law, even for house property income, they have said year-end rate. This is a little bit illogical because generally house property income accrues from month to month basis. See, house property income is rental. And rent income is an income which arises from month to month, month to month, month to month. So logically, it should have been month-end rate. But let's not argue, we cannot change the law. But this is little bit weird. Everything else looks convincing, but this is little weird. Logically, my opinion is what even HP income, law should have converted according to month end rate, because HP income arises from month to month. It's rent income. Yes, PGBP income is profits. That is computed at the end of the year. Anyways, let's not go into this because we cannot change the law. We have to accept the law. So tell me how to by-heart this whole table. Just by-heart these three red things. Which three red things? House property income, PGBP, and income from other source other than interest on security and dividend. These three incomes you by-heart year-end rate, year-end rate, year-end rate. Rest all income, month-end rate. Okay. Now tell me, this is for converting the income amount. Income amount. But in our solution, we also want this thing. Na? Look, wait. What is this? Actual foreign tax. This is needed in a formula when there is data. So tell me, actual foreign tax also where you paid? You are paid in India or foreign? See, actual foreign tax means the tax paid in foreign. Even this you might have paid in dollars. So when you solve the sum, even this will be given in dollar terms. So how to convert this? Again, month end rate. Preceding the month when you paid the tax in foreign. Means if in the question they say, this actual foreign tax was paid in foreign in the month of October. It was paid in the month of October. So October preceding month is September. So rate as on 30th September. See, do you agree? Even this is required to be converted. See, actually all foreign incomes requires conversion. And foreign taxes require conversion. This I explained first. Tell me what was the rule which I explained here. Everything according to month end rate except PGBP, house property income and income from other than interest on security and dividend. That will go according to year end rate. Rest all month end rate. And now I am talking about this thing. This also you will convert according to month end rate. But which month? Preceding the month when you actually paid the tax in foreign. So all this is given in rule number 115 of income tax rules 1962. See, last I have written this also. Foreign taxes paid, you have to convert according to month end rate. But which month? Month preceding the month when you actually paid the tax in foreign. Now, and nowadays, they create question of double taxation where all the foreign incomes are given in dollars and pounds, so that your conversion knowledge is also tested. So now we will take one question of this type. See, question is normal. As we have done question 1 and 2, it's the same thing. Only unique part of the question will be, you will find foreign incomes expressed in foreign currency. So see, the question is question number 3. This is from ICA RTP. In one RTP, this question was given. Okay. Read this sum. Mahesh, age 50 years, is CEO of Silver India Limited since 1st April 2020. Now do one thing. Read the last line of the question. Tell me in the question of double taxation what they ask. Compute the total income and tax. It is fixed. They will always ask compute the total income and tax liability. And you can literally by heart the template of our answer. Tell me what is the format of the answer. All 5 heads and then Satak, Latak, winnings balance and then working note for relief calculation. You can literally by heart the format. At least see, even if a tough question comes in the exam, if you systematically draw the formats, at least you will get some marks. This is in worst case. Huh? Generally, based on this much, you will be able to attempt exam question. So, what I will do now? We will classify all the given incomes into different heads. Wait, did you see in this question rate of exchange is given? $1 is this much. We'll see which rate to be used. Let us start from the beginning. Wait, one more thing. Assume Mahesh pays tax under 115 BAC, means he is paying tax according to new regime. So we will go as per new regime. Okay. Read. His income in India consists of this much and his income in country A consists of this much. See, by now you should have by-hearted in the questions of double taxation. Few incomes they will give of India, few incomes they will give of foreign. But while classifying into different heads, you should not bother whether it is Indian or foreign. Just apply the rule of heads of income. So tell me, what is the first income? Salary. This will come in which head? Income from salary. So write there IFS, income from salary. Then before standard deduction. So what is the standard deduction? Under new regime it is 75,000. What about interest in respect of self-occupied property? You know, self-occupied property is a property in which we stay. And in this property, even if you don't get any income, still you get deduction for interest on housing loan. You know how much deduction you get? 2 lakhs. Maximum 2 lakhs deduction is allowed for interest on housing loan in case of a self-occupied property. But under new regime, that is not allowed. Under new regime, that is not allowed. So see, here I have written deduction. Deduction under that IFHP. But then I have put a cross mark also. Why cross mark? Because the question is according to new regime we have to solve. If this would have been old regime, then under house property, self-occupied property income is 0 and then minus 2 lakhs. 2 lakhs is maximum. Actual amount is 1 lakh 80, so you will minus 1 lakh 80 only. 2 lakh is the maximum limit. But here it is 180, so you would have deducted 1 lakh 80 and you would have shown loss under the head house property if it was old regime. But under new regime, interest deduction for self-occupied property is not allowed. It is only for self-occupied property, interest deduction not allowed. Huh? For normal let-out properties, deduction will be allowed even in new regime. You know, there are 2 special points in HP under new regime. One is for self-occupied property, interest deduction which is generally allowed up to 2 lakhs is not allowed in new regime. Other point, under HP head, if there is a loss, generally that loss you can set off with other head up to 2 lakhs. But under new regime, HP loss cannot be set off anywhere. These 2 special points you have to remember, especially for house property income. See, actually, I don't know whether you remember that. Look at this. If you are thinking where from all this knowledge sir is giving, so let me show you. I have taught you all this. Look, in one lecture I taught you 115 BSc. See, I'll remind you. Look, that time I told you under new regime there are 5 attractive things. But for that there are 13 sacrifices. So check if you want. Interest deduction for self-occupied property is not allowed. And set off of HP loss with other head is also not allowed. Which is generally allowed under old regime, but under new regime it is not allowed. Okay. Anyways, this in exam you might have studied properly, na? So in exam you will be able to apply the knowledge easily. Then what about interest on bank FD? Which head it will come? I am classifying into different heads. Income from other sources. Then is income in country A. First is income from business in country A. Business income will come where? PGBP. I have written IFB. But did you notice? Income is expressed in Indian rupees or dollars? Dollars. So how will you convert $25,000? Now use this knowledge. PGBP income is according to year-end rate. So what is our year-end? 31st March 26. So check all the rates of exchange are given. Can you see 31st March 26? What is the rate of exchange? $1 is equal to rupees 71. So this is the rate of conversion you will follow. So see, I have written here, you can also mention $1.71. So for $25,000 multiply by 71. Then what about rent from house property in country A? Firstly, decide the head. IFHP. Okay. And decide how to convert. Even HP income you convert according to year-end rate. I told you, na? And what is the year-end rate? 71. And what do you mean by this? Municipal tax is not allowed as deduction in country A. So this is foreign law. And in your main answer, you have to go according to Indian law. Tell me, when should you pay attention to foreign law? Give me precise answer. When I want to calculate the actual foreign tax and the foreign tax rate, only then we have to see the law of foreign. Otherwise, in your main answer of computation, you don't have to see what is the foreign law. Okay. So we will take deduction. See, I have written deduction. See, here some student asked me that out, sir, this is a question on new regime. So what? Under new regime, municipal tax is allowed. Tell me, what is special under new regime? For HP income, interest deduction for self-occupied property will not be allowed. And HP loss, which is generally allowed to be adjusted up to 2 lakhs with other head, that is not allowed. Rest all things are normal. Then, what about dividend income? First, decide the head. Income from other sources. So, write DFOS. Now, decide the conversion. This dividend was declared in the month of March. And what is the amount of dividend? 10,000 US dollars. So, tell me, for dividend, what protocol we have set? Dividend is according to month end rate. And month preceding the month of declaration. Nothing is given, it's a final dividend. So, you will take declaration month. So, when was dividend declared? March. But don't take March. Month end means preceding month. So, what is preceding March? Feb. So, Feb end rate you will take. Feb end. And see, Feb end rate is 70. In the question, there is a printing error. By mistake, it is written 29th Feb. It should be 28th Feb. That is a printing error. 28th Feb. Okay. So, $1 will be 70. So, here I can mention $1, 70. Then, short-term capital gains. First decide the head and then conversion. Head will be CG, capital gains. But see, this is $5,000 on sale of shares registered in country A, and sale proceeds were credited in bank account outside India on 20th March 2026. Tell me here what they are saying. Which shares we have sold? Shares of Indian company or foreign company? The shares are of companies registered in country A. Country A means foreign. So, foreign company shares we have sold. So, capital gain is accrued in foreign. Received also in foreign. See, it was deposited in a bank outside India. So, do you agree? This was a capital gain accrued also outside India, received also outside India. But so what? For resident, world income is taxable. I am just drawing your attention to the fact that here there is a capital gain which is accrued abroad, received also abroad. It is technically a foreign income, but for resident, world income is taxable. You know, in the questions of double taxation, we will always be resident. Because residents people have to suffer double tax. Because the country where we reside, they will also tax. And the source country will also tax. So tell me, how will you convert this $5,000 capital gain? For capital gain, what is the rule? Month end rate. Preceding the month when the asset was transferred. So when did we transfer the shares? Nothing is given. So we will assume, see, actually 20th March is the date when you deposited the sale proceeds in the bank account. We will assume sale also occurred in the month of March. So if sale occurred in the month of March, what is the preceding month? Feb. And what is the rate of exchange on Feb end? Feb end is 70. So here also I will write 70. Taking March as a base. Preceding month will be Feb. Okay. So all incomes are done. Then read the para below. India has data with country A. Oh. So we have data. So formula will be doubly taxed income into average Indian rate compared with actual foreign tax amount, whichever is lower. Then tax paid in country A is eligible for tax credit in India. Tax credit in India means we will get relief later on under section 90. Whenever there is data, relief is under 90. Fiscal year for income tax is same both in India and country A. Means what they are saying, in both the country there is Same concept, April to March, April to March. Anyways, even if there is difference, we will go as per Indian law. Na? See, if by chance they would have said in foreign, the fiscal year, the tax year is Jan to December. So you should ignore that. We are filing the return in India. So we will go as per Indian law, and our Indian law says April to March. Okay. See, many times they will divert you by saying in foreign, so and so is the law. So let it be, na. I am filing the return in India, so I will go as per Indian law. Then rate of tax is 20% in country A in respect of all income. See, all income single rate. So there is no tension of average rate. Okay. But anyways, here we are not going according to rate, because this is a question of no data or yes data. Yes data. And whenever there is data, we don't compare between the rates. We compare between the amounts. But anyway, this rate will help us to calculate the actual foreign tax amount. Income tax was paid by Mahesh on 25th May for all the incomes in country A. Means in country A means foreign. So when did we pay tax in foreign? 25th May. Tell me, is this useful? Yes, useful, because see, in our solution, we will follow this formula. Actual tax paid in foreign. How will you convert actual tax paid in foreign? That also I explained. Actual tax paid in foreign is also based on month end rate, but month preceding the month when you paid the tax. In the question, what they are saying, we paid the tax on 25th May. So May is the month when you paid, but you have to take that month or preceding month. Preceding. So what is preceding May? April. So what is the rate of April end? April end rate is 72. So here 72 rupees per dollar will be useful. But you know, first you will have to calculate how much you actually paid in foreign. The rate of tax of foreign is 20%. But I don't want a rate. I want the actual amount of tax paid in foreign. So first I will calculate the amount in dollars. Then I will convert according to $1.72. See, why first in dollars? Because actually you pay tax in foreign in dollars. But then later on I will convert into Indian rupees. See, all this I am talking for what you know. When you have to calculate this thing, see, actual foreign tax. So for that we know the percentage, but we want the amount. So first that amount will be computed in dollars. And then how will you convert it back to rupees? According to 72. Why 72? Because you pay tax in the month of May. So preceding month will be April. Okay. So we have read the whole question. Now tell me what will come in our answer. First, all 5 heads of income. Tell me fast, one by one. In 5 heads of income, what is the first head? First head is income from salary. Do we have income from salary in the question? Check. IFS. See, that's why I have written the heads. IFS. What is the salary amount? 23 lakhs. But it is before standard deduction. So what is the standard deduction amount? 75,000, because it is new regime. So what is the answer? 22 lakhs 25,000. Then what about income from house property? Do we have? Yes, we do have income from house property. In fact, we have got two things: self-occupied property, let-out property. Self-occupied property, let-out property. But self-occupied property, answer will be 0. If it was old regime, answer would have been negative 1,80,000. But since it is new regime, you will not get interest deduction. So self-occupied answer is nil. But what is the answer of let-out property? Let-out property, your rental is $4,500 into 71 minus municipal tax 450 minus standard deduction. Is, you know, first you will compute full HP in dollars, then convert into 71. Do one thing, calculate in dollars. 4,500 is your rent minus municipal tax 450. So 4,500 minus 450 comes to 4,050 minus 30% standard deduction. Are you noticing I am going according to Indian law? So tell me, HP income in terms of dollar comes to what? $2835. And $1 is rupees 71. This was which rate? Year-end rate, year-end rate. Tell me, where do we take year-end rate? PGBP, HP income, and if was other than interest and dividend. So this was year-end rate. So what is the answer of let out property? This much in Indian rupees. Then what about self-occupied property? Nil. Why? Because interest deduction not allowed in new regime. Correct? Then go headwise. Salary is done, HP is done. Next is income from business. Do we have income from business in the question? Yes, we do have. How much? $25,000. Convert into rupees. So multiply by 71. Rate we have already decided, na? Then do we have capital gains? Even capital gains is there in our question. How much? Short-term capital gain $4,500 multiply by 70. So that comes to, sorry, I said 4,500. $5,000 multiply by 70. Multiply by 70. So that comes to 3,50,000. Then do we have income from other sources? See, notice the method of solving. I am solving in which method? Headwise method. Anything from income from other source, we have got two things. Interest on bank FD and dividend income. Amount 1,60,000 and dividend is 10,000 US dollar multiplied by 70. So dividend will be 10,000 into 70. Interest is in India only, that is already in rupees. So this way all 5 heads of income are done. So what is the GTI? 54 lakh something. Chapter 6 is not allowed because new regime. Then final answer 54 lakhs 11,290. Then Satak Latak winnings balance. Satak Latak winnings is nil. Whole amount will go in balance. So what is the balance amount? That's same 54 11 290. Then tax. You will apply which slab rate? Old regime or new regime? New regime. Question is on new regime, na? And what is the shortcut in new regime? See, her doubt is what you know. So here, short-term capital gain under 111A, we prepare a separate column. And in the question, there was short-term. Correct, see, look, correct, look. In our question, there was short-term capital gain. And that was arising from equity shares only. But it is non-STD paid. How do I know? STD is paid when the shares are transferred in Indian stock exchange. And here, because the shares are of foreign company, we might have sold these shares in foreign stock exchange. And when shares are sold in foreign stock exchange, you don't have to pay STD. And if no STD paid, it cannot come in Satakji under 111A. What is Satakji under 111A? It is for equity shares, but STD paid equity shares short-term gain, na? Here it is non-STD paid. It is equity shares, but non-STD paid because shares are of foreign company, stock exchange of foreign, no STD concept in foreign. So that's why nil here. Tell me, slab rates, shortcut for new regime, directly multiply by 30%, then minus 4 lakhs 20,000. So what is the answer? 12 lakhs 3,387. Then surcharge will come because our income is above 50 lakhs. 10%. Then health and education says 4%. Now comes the main point, relief under section 90. Why 90? Because there is data with India and foreign. What is the formula for relief when there is a data? Doubly taxed income into average Indian rate compared with actual amount of foreign tax paid. So tell me one by one. First find out, okay, let's find out a simple thing first. Average Indian rate is always simple because already our answer is ready. Look, what to do? Final tax after health and education says divided by final income. Divide and calculate the percentage. That comes to how much? This percentage comes to 25.44%, correct? So this is done. What about doubly taxed income? This you should do it very carefully. Tell me what rules I have repeatedly said for doubly taxed income. Firstly, your eyes should not be on the question, it should be on the solution. And your eyes should search incomes coming from foreign. And that too as per Indian law computation. Okay. So see, my eyes will go in the solution. And now I will figure out income coming from foreign. So tell me which incomes have come from foreign. See, I have written here. Country A, look. Country A, look. Country A, country A. These incomes have come from foreign. Okay. So now tell me the amounts. And that also computed as per Indian law. So HP income is 201, 285. Business income 17 lakh 75. These are being doubly taxed, huh? These were taxed in foreign also, it's taxed in India also. But we will see how India is taxing according to Indian law. See, India is taxing rent income after standard deduction. So we will see how India is doubly taxing Indian law. So this amount is this, business amount is this, short term capital gain is this, then dividend amount is this. Just add. Add all. Add fast on your calculator. So there are 4 amounts, correct? If you add all these 4 amounts, you will get doubly taxed income. See here. 4 amounts. 1, count. 2, 3 and 4. Those 4 amounts which are highlighted I have simply added here. Multiply by average Indian rate which I calculated below. See, this is simple. I have directly taken the figures from the statement of total income. Then actual tax which you paid in foreign country A. Tell me what is the tax rate in foreign? 20%. It was given in the question. See, in foreign the rate of tax is 20%. Now see how I am figuring out this amount. 20% is there, but in foreign you pay tax on this income, this income, this income, this income. These are the incomes coming from foreign. So you should have paid tax on these incomes. But in foreign you pay tax according to foreign law. Now you will go as per foreign law. Didn't I say whenever we calculate the foreign taxes and the foreign percentage, it is as per foreign law. So see, in country A, rent is taxable on gross basis without any deduction. So keep it on your calculator and keep it in dollars only. Why dollars? Because in foreign we pay tax in dollars. So our dollar income of rent is 4,500. Take it on calculator. Then business income $25,000. See, I want to keep it in dollars because actually I pay tax in foreign in dollars. So 4,500 plus 25,000. Then how much is my short term capital gains in foreign? 5,000. How much is my dividend in foreign? 10,000. Add all these amounts. Add 4,500, 25,000, 5,000 and 10,000. If you add all, how much you get? 44,500. 44,500. Multiply by 20%. So that comes to how much? 44,500 multiplied by 20%. But that will be the tax in dollar terms. How to convert into Indian rupees? This also I explained, right? Look, foreign tax is paid, you have to convert according to month end rate. Month preceding the month when you actually paid the tax. So when did you actually pay the tax? In the month of May? So we took April month end rate, 72. So see, multiply by 72. So see, first I calculated my taxes in dollars, then convert into Indian rupees according to the month end rate, month preceding the month where you paid the tax in foreign. So now I have got 2 amounts, doubly taxed income into average Indian rate and actual foreign tax paid is this much. Out of the 2, whichever is lower? What is lower? 6,80,800, sorry, 6,40,800. So this I will subtract in relief. Look at this. And then your final answer is this much. And final answer, last digit should be 0. If not 0, round it off. At the end, it is 875. 875 can be called as 880. So this was question number 3, where amounts were given in dollars. Okay. Then see, next is question number 4. Read question number 4. Read this. Samir is performing musician, resident of India. See, generally in the double taxation question, you will be a resident. And what will be asked in the question? Compute the total income and tax payable. These are standard things. Huh? So let me highlight. Compute the total income and tax payable. And you should be interested in knowing whether it is old regime or new regime. That is always mentioned in the question. Huh? Here they have written, Samir has opted to shift out of default regime. Default regime is new regime. And you are shifting out. Means you want to go out of new. So that means you are in old regime. Okay. And read this last para. India has not entered into double taxation avoidance agreement with country A and B. So we have data or we don't have data? We don't have data. Okay. So no data means formula is what? Doubly taxed income into average Indian rate, average foreign rate, whichever is lower. So tell me, how will I proceed? Step 1. All the incomes will be given mixed. We will have to classify into different heads. Do you think? Imagine as if you are solving the sum. Means your mind should think faster than my words. So tell me, first point. Income from music performance in India. Figure out it will come in which head. He is a musician. It is his business. Business or profession. It will come in PGBP. He is a musician only. So this will come in IFB. We have written IFB. Okay. And then what about dividend received from Blink Limited? Dividend comes in income from other source. Now pay attention. One most important point. Look. Can you see the word received? Received means it is net of TDS. You know, dividend income, there is a TDS. I don't know whether you remember CD Vakrap CP, CD Vakrap CP, CD Vakrap CP, CD Vakrap CP, CD Vakrap CP. In CD Vakrap, what was D? Dividend. And dividend income is always subject to TDS. Yes, there is a threshold of 10,000 in dividend. That up to 10,000 TDS will not apply if the shareholder is individual. But here the dividend is of huge amount. See, 1,35,000. And how do I know it is net of TDS? See, when you actually receive dividend in real life, what you receive in your hand is not gross. It is after cutting TDS. And here they have clearly written the word received. You know, this word generally students will never pay attention to in exam. And you know, couple of times in past paper it has happened, they've used the word received. And if you overlook the word received, you will put 1,35,000 EFOS. But you know, whenever the income is net of TDS, you will record net amount or gross amount. Gross amount. You will have to write the gross dividend. So do one thing, you can mention there this is net. Tell me how to make it gross. If this figure is 90%, why 90? Because the TDS is 10% in dividend. So after 10% TDS net will be 90. If this is 90, so 100% is how much? Cross multiply. So gross amount comes to 1,50,000. Now you should have a doubt, but sir, why didn't we do this in the previous questions? You can check if you want. In the previous question, they didn't write the word received. Look here, look. I will show you. Right now we solved this question. In the last question, there was dividend from shares. Did they write received? No. I'll show you one more question. See. We did this question 2 also. Here also there was dividend income. Did they write the word received? Trust me, nowhere it was there. Had it been there, I would have told you, na. So now at least make a rule. Whenever the word received is given, it is net of TDS. You can write somewhere at the top margin in bold letters. Whenever the word received is given, It is net of TDS. Whenever the word received is given, then put a star mark on received, 2-3 stars on received. Whenever the word received is given, it is net of TDS. You know, in past paper, many times in the question of NR taxation, listen this carefully, huh? Many times in the question of NR taxation, remember NR taxation 115A? In 115A, many times we had learned TDS about 194 LB, LC. So see, when we did questions of NR taxation, nowhere we came across the word received. But trust me, if you see past papers, especially questions of NR taxation, many times in the question, they have given the word received. Like in one question, there were rupee denominated bonds. You remember rule for interest on rupee denominated bonds? If it is of company listed in IFSC 4%, 9%, such points have come in paper and they have used the word received. See, they will not directly tell you it is net of TDS. They will give the word received. So you have to imply. But see, don't hype the word received every time. Huh? It is only for items which are TDS oriented. See, dividend is a TDS oriented item. Every item is not subject to TDS. Huh? It is only for the TDS oriented item if you see the word received. It's a silent hidden adjustment that it is net. So you will have to make it gross. Means you will write how much dividend in IFOS? 1,50,000. And the TDS you will adjust at the end after health and education cess. Then next point. Income from foreign country A. See, there are two countries in foreign where we are getting income from. And the tax rates are 20% and 10%. So one by one. What about agriculture income in country A? First tell me the head. Income from other source. And here what is the common mistake, you know? Students do this as exam under section 10.1. This is not exam. Agriculture income is exam if it is in India. Here agriculture activity is happening in foreign country. So it is not exam, it will be taxable. But tell me, it is $4,000. How to convert this? Tell me which rule you will follow. Which rule? Income from other source, other income. Year-end rate. So look for year-end rate. What is the year-end rate? See this. 31st March 26 is our year-end. So rate will be $1. Tell me what is this 1 CAD? 1 country A dollar. EAD means country A dollars. You can write if you want. Otherwise you will wonder what is 1 CAD. 1 CAD is country A dollars. See here their dollars are given. Okay. And country A. So they mean to say CAD means country A dollars. Country. See there are many countries where dollar is the currency. But here our country is country A. So it is country A dollars. Okay. So tell me which rate I will take for agriculture income. $1. 80 rupees year end rate. Then what about rent from house property in country A? It will come in which head? First figure out the head. IFHP head it will come in. And then how will you convert this? How to convert HP income? Even that is according to year end rate. Year end rate is what? $1.80. $1.80. And what about this municipal tax? Is not allowed as deduction in country A. Don't pay attention to that, because when you prepare 5 heads of income statement in India, it is according to Indian law. So we will take deduction. So see what I have written here. Look, I will take deduction and I will also take standard deduction, because in the main computation you have to go as per Indian law. Tell me when will you pay attention to the foreign law? Tell me fast. When you want to find foreign tax rate and foreign taxes paid, only then you have to see the foreign law. See, certain things I am purposely repeatedly saying so that it should fix inside your brain. And the things which I am repeatedly hammering, I would suggest you also make notes of that in your book. Then read next, income from foreign country B. See, there are 3 incomes in country B, but they have not given the nature of the income. Have they given the nature of income? We will take it in EFOS. We will take it in EFOS. And they've already given in rupees terms. So no tension of conversion. But read. First income is earned during Jan 2025. See what they've written. Country B follows calendar year. Calendar year means Jan to December. So in country B, there is a concept of Jan to December. But in India, what is the concept? April to March. Again, I repeatedly say, when we are preparing our answer, it is as per Indian law. To hell with the foreign law. So foreign law might be following calendar year, but I am solving this sum for India. So I will go as per Indian law. So go as per April to March. And if you go as per April to March, this income should not be counted. Because this is not falling in our April to March. You don't know what is our April to March. 1st April 25 to 31st March 26. This is our previous year. So our previous year in exam starts from 1st April 25. April 25. This is Jan 25. So I will put a cross mark on this. Ignore. See, ignore, consider for what? See, I am preparing the statement of 5 heads. And I am preparing the statement from 1st April 25 to 31st March 26. In that, this income will not fall. Okay. Actually, this income we have reported in India last year only. This income we reported in India last year. Because in India, last year was ending on March 25. So we reported last year. So current year ignore. What about income of July and Jan 26? These two pertain to our financial year. So these two will be taken. Under which head? EFOS. See, nothing special. When a student does on his own, he finds it tricky. But simple rule, whenever you are preparing the computation statement, go as per Indian law. That's it. Then what we have below? Read this. During the year, he repaid 2,40,000 towards education loan. You know, whenever you repay education loan, interest component is allowed as reduction under 80E. Didn't I say at the start of the topic that in the topic of double taxation, they will frequently test chapter 6A and new regime knowledge. Trust my experience. If you want to be successful in double taxation question, your chapter 6A and new regime concept should be thorough. Okay. So this will come in 80E. But in 80E, only interest component is allowed as reduction. And there is no limit. Full interest paid is allowed for 8 years. And here we will assume the loan repayment is within 8 years only. Then he is eligible for basic exemption limit of $2,000 in country A. And on balance income, 20% tax in country A. You know what they are saying? In country A, there is a slab rate system. What is the slab rate in country A? Up to $2,000, 0% tax. Balance income, 20% tax. That means country A has got single rate or two rates? Two rates, 0 and 20. So concept of average will come. And anyways, in this question, we don't have data. And questions where there is no data, what is the formula? Average Indian rate, average foreign rate. So when you find average foreign rate and once you see there are multiple rates, importance of average will come. See, earlier we felt that in country A there is only one rate, 20, but that was deceptive. Below they have clearly given that 20% is for the excess amount, balance income. Up to the level of $2,000, the tax is 0. So we'll see how to do that. But in this question, calculation of average rate will be important. That's it. We have read all the information. Now tell me how your answer will start. You will go headwise. What is the first head? Income from salary. Do we have anything from income from salary? Nil. Then what is the next head? Go headwise. Income from house property. Do we have income from house property? Calculate and give me the amount. Calculate. First calculate, then convert into rupees. Huh? $3,000 is the rent minus municipal tax $300. That comes to $2,700 minus 30% standard deduction. Standard deduction is also there, na? So that comes to something in dollars. Multiply by 80 rupees. So give me the answer. Keep your calculator ready. Huh? That comes to how much? 151,200. That is income from house property, correct? Then I am going headwise. Next head, income from business. Do we have income from business? Yes, we do have. 3,50,000. Income from music performance. It is directly given. So see, I will write income from business also. Then headwise, next head, capital gain. Capital gains is not there. Then income from other source. Tell me what items we have in IFOS. We have dividend which was given net, but we will take gross. Count one dividend, then count. Then agriculture income is there. Second, agriculture income. Then there were some general incomes coming from country B. Why I am saying general? Because the name of the income was not given. Na? So see, we have got dividend income in IFOS, we have got agriculture income, and these two figures coming from country B. So see, I have written here. Dividend income, how much I have written? 1,50,000 gross amount. Agriculture income was given. What was agriculture income? $4,000 multiplied by $1.80. Then income from country B, I have taken 1 lakh and 3 lakhs. What is this 1 lakh and 3 lakh? Those two amounts which pertain to my financial year. I have not taken the income of Jan 25. It belongs to the preceding financial year. So I have taken 1 lakh and 3 lakh. That comes to 4 lakhs. See this, 4 lakhs. That's it. The gross today income is this much. In chapter 6, we had 80 interest on education loan. So this is net taxable income. Then Satak, Latak, winnings, balance. We don't have anything in Satak, Latak, winnings. The whole thing will go to balance. And here it is new regime or old regime. See, here they have said we have shifted out of default regime. So we are going as per old regime. And what is the shortcut in old regime? Keep your calculator ready fast. This will directly multiply by 30% minus 187,500. Shortcut method. 13 lakhs 1,200 into 30% minus 187,500. Shortcut. So this is tax as per slab rates. And then surcharge not there because income is not exceeding 50 lakhs. Health and education cess will come. Okay. So till here your answer is normal. Okay. Now how will you calculate the relief? There is a formula for relief. What is the formula? Doubly taxed income into lower of average Indian rate and average foreign rate. Lower of the two rates. So see, the formula is doubly taxed income multiplied by average Indian rate, average foreign rate. So do one thing. First let us find out average Indian rate. What is average Indian rate? This you can get it from the answer only. Final tax after health and education cess divided by final income. Convert this into percentage. That comes to how much? 16.214. Okay, this is average Indian rate. Then average foreign rate, how will you find out? The average foreign rate for country B, it is simple. 10% is given. For country A, it looks like it's given, but don't get carried away by 20. See this information, what was there? There is a concept of basic exemption limit in country A. And basic exemption means up to that amount of tax is 0%. 0% is also percentage. No? It has a relevance. But that is up to 2,000. So what is my total dollar income in country A? See, this is $2,000 basic exemption. So now what is my total dollars coming from country A? See, from country A I am getting $4,000 and $3,000. And right now I am struggling to find average foreign rate. Average foreign rate will be as per foreign law. See, we are finding average foreign rate. It's as per foreign law. So in foreign law, municipal tax is not allowed. Ignore. So in foreign, we have got practically only two incomes. Agriculture income and rent income. and according to foreign law, my income is $7,000. Agree? So see what I've done now. Look here. $7,000 is my income. And what is the basic exemption in that country? 2,000. You understood how did I get 7,000? 7,000 was simple addition of what? Agriculture income 4,000 and rent income 3,000. And here I have taken rent as plain 3,000 as per foreign law. Because whenever you calculate foreign tax rate, go as per foreign law. So 4 and 3, how much? 7,000. Do you agree there is no other income in country A? Now, up to 2,000 basic exemption means 0%. And for balance it is 20%. Now, this is the total foreign tax divided by total foreign income. Convert this into percentage. This comes to how much? 14.286. Yeah, whatever. So, in country A, this is the foreign rate which we calculated. See, country B, there is one single rate only, 10%. See, you understood these two rates? Rates is simple, clear. Now, doubly taxed income, how to find? Tell me what rule I have set for doubly taxed income. Repeat. My eyes will be inside the question or the solution. And my eyes will search income coming from foreign and computed as per Indian law. Okay. So see, this is the solution. So I will put my eyes here. And I will do it country-wise. Country-wise. There are two countries, country A, country B. So let's talk about country A first. So tell me which incomes are coming from country A. I will highlight with yellow color. Country A. Tell me where else country A is there. Agriculture income. That's it. Okay. So see, firstly my eyes should be in the solution and then my eyes should be on income coming from foreign. So which I have already highlighted. And that also as per Indian law. Doubly taxed income is as per Indian law. So this is one amount and this is another amount. Has India done any special incentives for this income like chapter 6 and no? So these two amount will be taken plain as it is. Add 151,200 plus 3,20,000. This becomes doubly taxed income of country A. What was the total? 4,71,200. See here. Correct. And what about country B? See, country B I highlight with different color. Country B income is here. Only one thing is there, that's it. 4 lakhs. So that is doubly taxed, 4 lakhs. So 4 lakhs. Okay. So then doubly taxed income multiply by lower of the two rates. So this will be the relief for country A. This is relief for country B. So what is the total relief? 67,316 plus 40,000. If you add both, you have to combine the reliefs of both the country, na? If you add 67,316 plus 40,000, it comes to 1,07,315. Then you will also get the credit of TDS. In this question, dividend income we received net of TDS. So TDS was how much? 10%, that is 15,000. Gross dividend was 1,50,000. TDS will be 10% of that, 15,000. See, look here, look. You will have one doubt here. Sir, when to show the effect of TDS at the end? See, grossing up we understand. If the word net is given, received is given, we will do grossing up. Otherwise, if the word net do not come, received do not come, we will not do grossing up. But the fact remains, TDS is there on certain incomes. And whenever there is a TDS, you have to show it at the end. In all my previous question, I didn't show. Don't say, but sir, here it was net. See, net is for grossing up. But in previous question also, there was dividend income. Do you agree? In the previous question also, there was dividend income. Yes, we didn't do grossing because it was already gross. But it was dividend, na? So there is always TDS on dividend. So we didn't show the effect of TDS in the previous questions. You know why? Look, whenever the question uses the word tax payable, you give the effect of TDS. But if the question says tax liability, no need to show the effect of TDS at the end. Because see, in many questions we solve, you will find items subject to TDS. And everyone knows TDS is adjusted after health and education says, but when to show that knowledge? Only when the question says tax payable. You can write somewhere if the question says tax payable, calculate tax payable, hammer on the word payable, payable, payable. Then adjust TDS at the end. And if the question says tax liability, then no need to show the effect of TDS. Like see, if you see the previous question, look. Here what was asked? Tax liability. Okay. One more question I'll show. Look. See here there was one question, tax payable. Okay. Here the question was of tax payable. So here also ideally you should adjust a TDS. TDS for what? Dividend income. Here also the question was on tax payable, and whenever the question says tax payable, it is always better to show the effect of TDS. I didn't do because in the ICS solution they are whimsical. Sometimes they do, sometimes they don't do. But you make a protocol. See here also ideally speaking at the end I should have given the after health and education says I should have shown the effect of TDS on dividend. Because dividend income is subject to TDS, correct? Okay. And see, you might say, sir, this way TDS can come in other income also. But see, other income, only if there is a confirmed TDS you have to take. Like in rent income, TDS sometimes comes, sometimes it doesn't come. Depends upon the payer is a small individual HUF or not. See, for items which are confirmed subject to TDS, there only you should bother much. But there are, if you remember in the topic of TDS, Rachi's income, sometimes some people are exempted from TDS. So for controversial item which may or may not be subject to TDS, don't think much. Only for confirmed things where TDS always comes, there you bother about TDS. So see, in this question there was a glitch. In question 2, since the question was saying calculate the tax payable, you should have shown the effect of TDS deducted on dividend, but since ICA has not done, even I have not shown. Okay. See, best is what you know on safer side. Whenever you see the word payable, you show the effect of TDS. Wherever you can see, TDS should have come. Okay. But many questions, they have not even given the effect of that. See, this question precisely which I was doing right now, where the word received was there, here they have specially shown the effect of TDS. One more thing, one more technical problem in ICA. In few past paper, they have given the word received, but still they have not done grossing up. These are some few mistakes of ICA solution. Many paper you will see the word received means they are treating it as net and they are grossing it up. But I have seen few papers, in spite of the word received, they have still assume it's gross. Tell me, what will you do finally? There is difference in the solution of ICA at different times. What will you do? First rule, whenever the word received comes, write a note, it's net, and you will gross it. And at the end, this type of effect, after health and education says, when you should provide if the question says calculate tax payable. But if the question simply says calculate the liability, the liability means how much you are liable to. But if they say payable, is after adjusting TDS, how much you have to pay. So if the word is payable, adjust TDS. If the word is liability, just end the answer without TDS effect. Okay. Anyways, let's not go into much details of this because ICS sometimes they show the effect of TDS, sometimes they don't do. This is also my trick which I am giving. If the word is payable, it is better to show the effect of TDS at the end. Okay. See, this thing which I am saying, If the word is payable, show the effect of TDS at the end. If the word is liability, then no need to show. But in any case, this grossing up thing has to be done. See, regarding grossing up, I am not saying you have to see what is asked, whether it is tax liability or tax payable. That is, I am saying for what? At the end, whether to show the credit of TDS or not, that depends upon the terminology. But regarding grossing up or not, you have to always gross up whatever the question says at the end. Whether they say tax liability or tax payable, grossing up is always done, provided the given figure is net, or if they don't write net, it is hidden adjustment by the word received. Grossing up you have to always do. For that I am not keeping it dicey. Although ICA has made blunders in some papers, but you make a rule for yourself that grossing up I will always do once I come to know it's net. But at the end, this thing, when you show the credit that some TDS is deducted, that much I won't pay, that thing you do depending upon the terminology of the sum. Okay. So this was question number 4. Okay. So this was question number 4. Then see, question number 5. This question, although I have given in this topic, but technically it pertains to the topic called model tax convention. When model tax convention topic is done, this question you will automatically understand. It's a very simple question from the topic model tax convention point of view. Right now, if you try to understand, you will not understand even a single word in this question, because this topic we have not done, na? Which topic? Model tax convention. But after that topic is done, this question is very simple. So this we don't have to do now. It will be done with model tax convention. Then question number 6. See, this question has come in some past paper, and this is a little weird question. When this question was said by ICA, people were shocked, because see the outlook of the sum, it looks horrible. But after you understand the solution, you will find it was nothing. See, this is the style of ICA. When they create the question, the outlook of the question will be such as if it's a horrible question. But when you see the actual answer, it is nothing. Okay. So here also you will have that feeling. The outlook is dangerous. Okay. So do one thing. First, as usual, let us read what is asked in the question. See what is asked. You are required to compute tax payable by Mr. Ram as per 115 BSc. As per 115 BSc means new regime. It is as per new regime we have to calculate the tax as per new regime. Okay. And this second point I will discuss later on. Right now we don't read this second point. Right now we just notice that we have to calculate tax. So again my answer will be 5 heads of income and then Satak Latak winnings balance. So read first part. Read this thing. Read in your mind once. Then I will discuss. Read. See what is given here. Ram is a citizen of USA, resides in San Jose in USA since 2008. So since 2008 he has been residing in USA only. Okay. He is a non-resident since AY 2829. Okay. He works in X Incorporation, a US based company. Okay. So up till now what they are saying, he is working in US, he has settled there, he is a resident in US. In India he is not a resident. Now what they are saying, he came to India on 10th Jan 2025 to visit his aged parents. See, his parents are in India. So although for job purpose he has settled abroad, but now since his parents' age is growing, so he might have felt like, let me meet my parents, because life is uncertain. What if suddenly my parents go away? So he wanted to visit his parents. So for that he came to India on 10th Jan 2025. Notice the data. Then he could return back only on 31st Jan 26. It's almost for 1 full year he was in India. See what happened on 31st Jan? He returned back to USA. That means he wanted to stay with his parents for 1 full year. Practically it's 1 year only, from Jan 25 to Jan 26. Then he was permitted to work from home in India. Because see, no company will give him holiday for 1 full year, na? He came to India for 1 full year for his parents. So what company might have said that since you are going to India, you can do work from home. So he was permitted to do work from home in India by his employer. Now, details of his earnings and withholding tax. Withholding tax means what? TDS. TDS is popularly called as withholding tax. Okay. Now, details of his earnings and withholding tax during the said period. What do you mean by during the said period? Which period they are talking about? From Jan 25 to Jan 26. The period during which he was in India with his parents, when he was doing work from home. In this said period, you understand English na properly? Earnings during the said period means during this period. See, you can check also from Jan 25 to Jan 26. This was his earnings. What was his salary? 8750. It was in Jan. After that, he got less salary. Why? Because these US people are smart. Huh? In Jan 25, practically he was there in US also. He came to India on 10th Jan. So it was work from home or work in office. 10th Jan he came to India. What about initial days of Jan? It was work from home or work in office? Work in office. So work in office, he was getting good salary. See, his salary was 8750. After that, full time it was work from home in India. So company might have reduced his salary. See, we don't have to do anything. It is just an observation. Then, this salary is given in Indian rupees or dollars? Dollars. And in double taxation question, when you record foreign income, how to convert salary income? I have explained that how to convert salary income. Wait, I will show. See, month end rate. Which month? Month preceding the month when the salary is due. Month end rate preceding the month when the salary became due. Okay. So for that they have already given the conversion rate also. See, these are the rate of exchange. $1 is equal to 71, 71, 72. Then it becomes, means initially it was 71, then it became 72. Tell me, this rate of exchange is of that month or preceding month? See, I want of that month or preceding month. I want of that month or preceding month. Preceding month. That's what I told you, na. We want month end rate, but which month? Preceding month. But my question is what? Are these rates which are written against each month of that month or preceding month? Preceding. See, it was given in the question. Read. This was the most important part. Because many students who don't pay attention to this, they feel these rates, like the rate of May 72 is of that month only. So see, they might have written the rates against each month, but it is not that month's rate of exchange, it is preceding month. How do I know? In the title only they have written. See, I will highlight this portion. Month immediately preceding the month in which tax has been paid or deducted. And tax will be paid or deducted when the salary is due. See, actually I want when the salary was due. So whenever the salary was due preceding that month, and the given rates are preceding month end rate only. You can also highlight this. Then read this. Federal tax, state tax, social security tax. These are the 3 tax he has to pay in foreign country. See, basically his employer is in foreign, and when US people give him salary, they will deduct TDS according to US law. So see, actually his gross salary is this much, but in his account it was deducted, it was after net of these taxes, and these are not Indian taxes, these are foreign taxes, and we are interested in foreign tax. Tell me, in the question of double tax, what is the formula when we have datta? What is the formula when we have datta? Doubly taxed income into average Indian rate or actual foreign tax. So these are the actual foreign taxes paid in US country. And for your kind information, here we have got datta. How do I know? Read. Read this. Read this para. As per Article 2 of Datta, this itself is sufficient. Means there is Datta. That's why they are talking about some provision of Datta. So with US, India has Datta. They are trying to say. Now what do you mean by this? Read. As per Article 2 of Datta, taxes covered for credit are federal income taxes imposed by Internal Revenue Code, but excluding social security taxes. Means India and US have made an agreement that when relief will be given only for federal taxes. Means India writes in the agreements. See, imagine our Indian government team has written that whenever whenever income is coming from US, you might have paid several taxes in US like federal, blah, 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 blah. But India will give credit only for federal tax. You know what is federal? Tax levied by central government. Like in India, we have got central government, state government. So similar concept is there in US also. Federal government, state government. Federal means kind of central government. So Indian government has agreed in the data that India will give relief only for federal taxes. That means if our Indians say, no, we have paid other taxes also, that's your problem. In agreement, we have already said we will give the relief only for federal. Exactly where in the agreement is it written, in Article 2. See, if you see real life data, it is drafted in article form. Article 1, Article 2, Article 3. In the topic of Model Tax Convention, you will study what is the exact format of a data. What are the provisions in real life data? This you will study in one separate topic called Model Tax Convention. And there you will have knowledge of different types of articles. See, articles are like sections. Like in Income Tax Act, there are various sections making provisions. In agreement, we don't have sections, we have got articles. So what does Article 2 of India US data say? That taxes covered for credit. Credit means relief. Taxes covered for the relief are only federal income taxes imposed by Internal Revenue Code. Means it's like central government of US. But excluding social security tax. So tell me, will you get relief for the state taxes? No. Relief will be given only for federal. How do I know? It's written. They have agreed to provide relief for only federal. So see, in federal I will put a tick mark. But in US also there are state government taxes. For that, what India has agreed? Sorry, we will not give you relief for the taxes which you paid to the state government of US. Yes, whatever you paid to the federal government, we will give the relief. What about social security tax? That also is written. Look, excluding social security tax. So social security tax will also be not subject to relief. In my mind, what is going on? This thing is going on. Look, see this. Whenever we have data, what is the formula? Tell me what is the formula? Doubly taxed income into average Indian rate. Compare with what? Actual foreign tax. And in my question, actual foreign tax is given in 3 different columns. Federal tax, state. See, the framing of the question looks horrible. But we want this thing. Which the question is of with data. Only thing is actual foreign tax is not given straightforward in a simple language. They have created 3 columns. And out of the 3 columns, I will select only first column. Which one? Federal. Because in US, there are different taxes for which India has said, sorry, we will not give you the relief. And how do I know India said sorry? It's written in Article 2, taxes covered for credit. Credit means relief are only federal taxes. Tell me one more thing. This actual foreign tax, you pay in foreign. But how do you convert into Indian rupees? This also I had explained. Actual foreign tax you pay in foreign. But how do you convert? Month end rate preceding the month when the tax was paid. This I had explained here. Look, if you don't agree, I have explained here. See. Isn't it? Preceding month end rate, preceding the month when the tax was paid in foreign. So tell me, when was the tax paid in foreign? In foreign also there is a culture of TDS. Every month's salary TDS was deducted in the same month. So tell me, these taxes you will convert according to which rate? That month's rate or preceding month? Preceding. And these rates of exchange are already preceding month. So you don't have to worry much. And one more thing. In the question they have given income from Jan 25 to Jan 26. But when we prepare the statement, it is from April onwards. So I am interested only in which salary? Salary which is April onwards. And what about these salary? Ignore it. Tell me why I am ignoring this previous months? Because this do not fall in my financial year. In fact, this first three amounts you have to simply ignore it. So tell me, give me the effect or look. Where will you write salary income? You know our template of the answer. In our answer, we have to arrange 5 heads of income. So in 5 heads of income, these many months salary will come. Because our statement is from April 25 to March 26. Okay. So these many salary will be shown. And these are expressed in dollars. We will convert into preceding month end rate. And the rate given besides each amount are already preceding month. Okay. And what is the use of this amount? This amount will be useful for providing the relief. Actual foreign tax paid. Okay. And these amounts you have to simply ignore it. Now, read this para. This is also very important part of the question. Read. First read, then I will explain. He has also earned fixed deposit interest in USA on 30th September 2025 of $200 TDS 20, and on 31st March 220 TDS 22. Means this is which income? Let me highlight. FD interest, FD interest, FD interest, FD interest. And what is the amount of FD interest? $200 and $220. Okay. So this income where you will take? FD interest comes in income from other source, but this will not be taxed in India. Because in this question, he is not a resident. You know, look, when world income becomes taxable, when you are resident and ordinary resident. And I will prove in this question, he is a resident but not ordinary. And what is the tax treatment of a not ordinary resident? Not ordinary residents are treated like NR only. They are also taxed only for income arising in India. And this guy, he has got salary which is arising in India because work from home in India. So this will be taxable because this salary is arising in India. But FD interest arose in US. How do I know? It's written FD interest in US. So he has got bank FD in US. So interest income is accrued in US. And income accruing outside India is outside the scope of NOR. You know why I am calling him as NOR? See, I will prove now. Look. So see. Wait. Tell me, what are his travel dates? When did he come to India? 10th Jan. And he returned back on 31st Jan. So look at this. Look at the screen at the top. When did he come to India? 10th Jan 25. So can you see this 10th Jan? And you know why I have drawn that with black color? Because that is not my year. It is preceding year. Our year I have drawn with blue color. Preceding year with black color. And do you agree 10th Jan 25 is not from our financial year. Our financial year starts with April 25. So this is belonging to the preceding year. So see, you came to India on 10th Jan. And in current year, you are in India till 31st Jan. See, on 31st Jan, he went back. So tell me how to count the stay. In the topic of residency status, I told you one Hindi slogan. There is one Hindi slogan to remember. जाने वाला दिन, आने वाला दिन, India में गिन. Means translate into English, means date of living and date of coming to India is counted in India. Date of leaving India, date of coming to India is counted in India. So see, this was date of coming to India. So count it in India. So 10th Jan count in India. So in Jan there are 31 days. Only 9 days will be outside. See, जाने वाला दिन, आने वाला दिन India में गिन means what? Date of leaving India, date of coming to India, count in India. So tell me what is this date? Date of coming to India. So count in India. So count 10th Jan. So in Jan there are 31 days. So minus 9 days. So how many days of Jan? 22. Feb 28 days. March 31 days. And then our year starts from April. And when did he go back to US? 31st Jan. So 31st Jan is date of leaving India. And leaving India also counted in India. Because when you leave from airport. So that is physically in India only. So full Jan he was in India. 31st Jan he left. So you count 31st Jan in India only. So tell me how many days he was in India in the current financial year. Add April, May, June, July, August, September, October, November, December, Jan. It comes to how many days? 306 days. Add all from April to 31st Jan. Am I right? It's how much? 306 days. Tell me why I'm counting only current year stay. You know how to calculate the residential status. First you have to check 182 days stayed in India or not. And that 182 days you don't have to see past years. You have to see the current year. And our current year is from April 25 to March 26. So current year stay is how much? 306 days. That means it is 182 days or more. He is a resident. And once you are a resident, you have to further check 2 more conditions. What are the 2 more conditions? In the preceding 10 years, you should have been resident minimum twice. And in the preceding 7 years, your stay should have been 730 days or more in India. Then you are a resident and ordinarily resident. But this guy's past years, if you see, he was hardly for few days in India. Before that, he was always in US. See, since 2008, he has settled in US. Yes, only for these few black color days. Can you see black color? He was in India. See, do you know for checking ordinary resident, we have to see the past years. Past 10 years, minimum 2 times resident. Past 7 years, minimum 730 days, which he is not able to fulfill. You can simply check this in past. He was only for these many days in India. So that means he is a resident, but not ordinary resident. Not ordinary. So tell me, if you are resident but not ordinary, only Indian income will become taxable. You know this I have explained where residential status. See here. Look at this. I will show you. Look at this. See, he has satisfied 182 days. Okay. But he failed to satisfy this condition. So he is NOR. Okay. And then see. What is the scope of NOR? In case of NOR, which incomes are taxable in India? Indian incomes and foreign business which is controlled from India. So in our question, we don't have foreign business control from India. Na? So only Indian income will be taxable. You know what I am trying to prove? That this income will not be taxed in India because it is a foreign income. Yes, if he would have been resident and ordinary resident, then world income is taxable. Then this would also have become a victim of double tax, because US people also taxing FD interest. India will also tax if you are ROR. But here I am ROR or R but NOR. I am R but NOR. So this income is not taxable only for me in India, because not ordinary resident, only Indian incomes are taxable. Salary will be taxable because it has accrued in India. Okay. And why salary is suffering double tax? US people, they are deducting TDS and accrued in India, so taxable in India also. That's it. The solution is simple. In our question, out of the 5 heads, we only have 2 income. Look, salary and FD interest. FD interest I will ignore, so I will take only salary. In that standard deduction of 75,000, because it is new regime. So look here, only 2 incomes are there in the answer. I told you first only, question looks horrible. Answer is damn simple. Tell me what amount will come here. You tell me here. Which amount will come here? Salary. Salary you will take from which month onwards? April onwards. So from April, if you count, how many months are there? April to Jan? 10 months. Each month salary is what? 6250 per month. So multiply by 10 months. But that amount is coming in dollar. Convert into preceding month end rate. And luckily for each month, the preceding month end rate is same. Otherwise, if the rates would have been different for each month, you would have separately computed. But here all are 72, 72, 72, you can see. So what will be the salary income? Tell me. 6250 multiplied by 10 months into rate of exchange $1.72. Standard deduction how much? New regime 75,000. So finally your salary will be 44 lakhs 25,000. 44 lakhs 25,000 will be your salary income. Okay. Then what will be there in income from other source? FD interest in US. I will show here. But in amount I will not take. Nil. Why? Because it is accrued and received outside India. It's a foreign income. And because I am NOR. Only, see, for NOR, I repeat, only Indian incomes will be taxed. Foreign incomes are not taxable. Okay. So then what is the GTI? Only one salary income is there. Chapter 6 say anyways you don't get under new regime. And there was no item also of chapter 6 by the way. So this is your net taxable income. Then Satak, Latak, winnings balance. We don't have anything from Satak, Latak, so whole amount will go in balance. So how to calculate tax on that? Use shortcut in new regime. Directly multiply by 30% minus 4,20,000. Shortcut in new regime. So what is the answer? Into 30% minus 4,20,000. It comes to 9,07,500. Correct? Then surcharge will not come because luckily you are below 50 lakhs. So no surcharge. What about health and education? Says 4%. That will always come. Now the last part of the question, relief under section 90. Why did I use the word section 90? Because there is data with US country. Okay. So tell me, what is the formula for data situation? Doubly taxed income into average Indian rate. Compare with actual taxes paid in foreign. Tell me, actual tax, actually we have paid 3 taxes in foreign. Federal, state, social security. But our data with US provides relief only for federal tax. It was given in the question. So what is the total of federal tax you have paid? 1,600 into 10 months. And into $1 is 72. We have to see preceding month end rate, and the rates given are already preceding month end. See. So what is the actual foreign tax paid? 1,600 into 10, $1.72, that comes to 11,52,000. And now doubly taxed income. What is the doubly taxed income? See, for doubly taxed income, what I say, your eyes should be in the solution and you should look for income coming from foreign. So which income has come from foreign? This whole income has come from foreign only. We don't have anything else. Whatever we have, that has come from US. So it is being doubly taxed. Why doubly? Because US people are also taxing. India is also taxing because salary is accrued in India. Because he was with his parents, work from home accrued in India. But what is the average Indian rate? How to find average Indian rate? Final tax in India divided by final income. Convert this into percentage. It comes to how much? 21.329%, correct? So now look here. Doubly taxed income is how much? 44 lakhs 25,000 into the average Indian rate is 21.329%. So see, actually you will get some decimals, but this same thing should be your answer. Because whole of my tax including HEC is arising because of that US income. So this working should match with this amount. See, if you take it on your calculator, this 44 lakhs 25,000 multiplied by 21.329%, you will get some odd figure. But then why it is coming to odd? Because this is in decimals, huh? It's not the exact number. And why I am confident that this amount, which amount? Doubly taxed income into average Indian rate should be the same as my answer. Because my actual answer which I have got after HEC, it is fully accountable to US salary. I don't have any other income in India, na? See, in our previous question, we had some income in India, some coming from foreign. Some in India, some coming from foreign. Here the whole income is coming from US only. So whole my tax is the victim of double tax. So now compare out of the two, whichever is less. In US you have paid federal tax of 11,52,000. But relief is what? Whichever is less. India is taxing only 943,800. So India will give relief of that much only. Although you might have paid federal tax of 11,52,000, you will get relief of whichever is less. So this amount will come here. So your final answer will be 0. Eventually you don't have to pay tax in India because your main income is salary coming from US, which has already suffered tax in US. So India, eventually you don't have to pay tax. See, by chance in US, this was not 11,52,000. You would have paid only 6 lakhs in US. Then relief would have been whichever is less 6 lakhs. Then you would have got relief of 6 lakhs. But you got full relief here because you have paid sufficient taxes in US. Okay. So this was question number 6. But see, the question is not yet over. Huh? There is one more question which is a pure theory question. Read this. Advise Mr. Ram on the procedure involved to claim foreign tax credit. What is foreign tax credit? This relief which you take at the end. See this. At the end, the relief which you get is nothing but foreign tax credit. Now tell me, in India, when he files the return, he is getting the relief. But it is not simple. You know what he will have to do? He will have to fill one form 67. By heart this now, by heart this. In India, when you file the return and if you want double taxation relief, I am talking about this relief. This relief, if you want, you have to file form 67. You know, in this form, what you have to show? Whatever income you have declared in US and whatever tax you have paid in US. This form is nothing but details of your foreign income and your foreign tax. So see what question is saying. Advise Ram. Advise him for the procedure. So what is the procedure? So your advice will be, dear Mr. Ram, you have to fill form 67. There you have to show your details of US income and US taxes. And then you have to produce one certificate which you prove that you paid the tax. Like in India, there is a TDS certificate. Similarly, US government, they have deducted my taxes. So there should be some official proof in the form of TDS certificate. That I should produce in India. Because the form 67 is filled myself only. Form 67 is self-filled form where you can write anything. The actual proof that you pay tax in US is a certificate. So see here, look, precisely you have to do two things. One is fill form 67. This can be filled by your own self. And in the form 67, what you have to show? Your income in US and taxes paid in US. But the main authentic proof is this certificate. This certificate is kind of a TDS certificate of foreign country. But you know, this certificate is either of tax authority of US, and if by chance in US there is a culture that tax authorities are not ready to give certificate, get it from the employer. And if employer also doesn't issue certificate, you have to yourself sign on your own. See, this is a certificate which first preference, it should be issued by income tax officer of US country. There also there are income tax officers. So first preference is what? Get the certificate from the tax authority of US. If that is not possible, then the company where you are working. And if that is also not possible, because see, sometimes foreign people, they don't cooperate. So what I will do, I will sign that certificate on my own, self-declaration kind of thing. Okay. So see, a certificate or a statement specifying the nature of income and the amount of TDS paid by the assessee. Okay. So these two things you will have to submit. Then only you will get this relief under section 90. You know, this thing I have written in my theory book also. If you see my concept book given to you, this thing is given in the concept book. And by the way, this rule is given in rule 128 of income tax rules 1962. See, relief giving sections are 90 and 91. Relief giving sections are 90 and 91. But the procedure to be followed is given in rule 128 of income tax rule 1962. So in exam you can write as per rule 128. First assessee has to submit form 67. What is the form number? 67. Here you cannot see on the screen, but in the printed book which I have provided you, you will find form 67 mentioned. And then one certificate either from the tax authority of US or your employer who has deducted TDS, or if they are not ready to give, sign it on your own and give one certificate. So this was question number 6. So from my side, this chapter is over. Double taxation topic is over. Okay.